It feels like something's cracking.
I think it's problematic for the equity markets that you're having such convulsive moves in the bond markets.
These high yields are starting to spread into credit.
We are not calling for a recession. We think that call is premature.
The economy is not going to be able to handle these rates, but the Fed is going to be the last to admit that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive by 0.1% on the S&P 500, poised potentially for a fifth week of losses on the S&P 500. In the bond market, the epicenter of the pain over the last couple of months, the epicenter of the headlines worldwide. TK going into all of that. 170 the estimate on Wall Street.
170 an estimate on Wall Street. We're going to conflate here a lot of economic talk. Mike McKee with our leadership at 8:30 and John the markets as well. And my major message here at 6:00 on a Friday is the markets still matter. It's going to be fascinating to see the reactions towards the jobs report and at 8:31.
Drum roll, I want your reaction to this. Is bad news, good news a little bit later this morning. Do you want to respond to that? Good news, bad news, good news?
No, you know how much I hate that. I get confused by it. And I'm sorry, employment in America is a big deal. 170 is frankly a generous number. And the unemployment rate actually matters this time around.
The ADP report was a little bit of a test for that theory earlier on this week. And Lisa, for ADP, bad news was kind of good news.
Except that if you look at some of the revisions from a lot of different analysts, they've actually revised upwards their expectations for what we get for the jobs report. The whisper number is 187,000, similar to what we saw last month. There is this question, though. At what point is it just bad enough to be good news, but not too bad to be actually something that's economic Armageddon? And really what I'm feeling is everyone's waiting for something to break this cycle. And even though we have a little bit of common markets, there's still 4.73% on a 10-year Treasury.
Amazing. My favorite note on a Friday comes from Michael Hartnett. It's called The Flow Show. Comes out every Friday morning. And in it, there's a question that he gets asked, and he provides an answer. Here's the question. What is no one asking you about? Here's the answer. 2024. How bizarre is that, Tom? Yeah. Here we are in Q4, and it's so weird that we just need to get through the fourth quarter. Hardly anyone's talking about 12 months out.
This is
next year.
so important. I'm old enough to remember is Steve Whiting that we used to have a 3-year vision. People like Steve Whiting would sit there and go, we believe 2027, boom. And it's just coming in with the pandemic and with the shock of this bond market, with a lot of the media catching up with what you and I have been talking about price. The answer is the vision is maybe out to Halloween.
Let's talk about the vision forward. A couple of companies thinking about the vision forward. Pioneer, Exxon. Let's check out those pre-market. TK, Exxon very recently, all-time highs. I understand that Darren Woods is looking for something to buy and that Scott Sheffield might have something to sell because Mr. Sheffield is looking to retire and Pioneer might well be on sale according to the Wall Street Journal.
On a game theory basis, my headline here is they've only got one person to sell it to, ExxonMobil. One is number 2, one is number 4 in the Texan basin. People are expert at this. Amrita Sen to join us here with some perspective as well. Frankly, Citigroup leads this morning with a terrific essay. We'll get to that later. John, let's look at scope and scale quickly here. Employees, Exxon and Pioneer, you know, it's maybe a 9-to-1 ratio, 10-to-1 ratio, and you've got free cash flow as well, about a 9-to-1 ratio.
Lisa, we're talking about potentially Exxon's biggest deal since '99, a $60 billion takeover.
Is this the beginning of reinvestment in fossil fuels, or is this the beginning of just basically consolidation as much as you can right now for cheap? Because there is this feeling that if you have big pockets, you'll be able to do things for a smaller company that the smaller company can't do on their own.
Exxon has big pockets. Their stock is slightly negative in the pre-market. Pioneer a little bit higher. We'll talk about that a little bit later. Here's the price action if you are just joining us going into Payrolls Friday. Futures are positive by 0.2%. Yields are a little bit higher by a couple of basis points, 473.81. The euro going absolutely nowhere. Bramo 105.57.
I'm wondering if we could really write the obituary on some of the bond market disruption if we do get some sort of upward surprise at 8:30 a.m. We do have the U.S. jobs report. The expectation is for 170,000 jobs, down from 187,000 last month. However, as some people are expecting, the whisper number is for it to be the same as last month with a declining unemployment rate. If we get that, what does the bond market look like? 9:45 a.m. I am so looking forward to this discussion. U.S. Acting Labor Secretary Julie Su joining our very own Jonathan Ferro on Bloomberg Television to talk about the labor market. Very curious to hear what she has to say about some of the labor movements and some of the action there.
He's going to grill.
I think it'll be a really fun interview to listen to.
This is going to be very polite, very relaxed. Tell us what you're seeing. What's happening? It's going to be that kind of conversation.
How do you feel?
He comes on.
How do you feel?
The earnestness.
Isn't that what I usually ask policymakers how they feel, right?
Always.
How do you feel?
What is your childhood like? Okay, 3 p.m. we have U.S. consumer credit for August coming out, and I think this is also pretty interesting at a time where you are seeing credit card debt rise at a significant and accelerating pace. How much of the consumer strength is being fueled by debt? Is this a warning sign or just a re-leveraging on pristine balance sheets post-pandemic?
Lisa, thank you. Steve Whiting with us this morning, I'm pleased to say, here in New York in the studio, Chief Investment Strategist, Chief Economist at Citi Global Wealth. Steve, good morning to you.
Good morning.
What are you and the team looking for at about 8:30 Eastern Time?
So look, I think 170 is not too high a reading. If you just take a look at what happened in the month of August, unadjusted employment again was, held back a little bit. You already said where these are trivial numbers if you really think about it, but we know them. We know that the number of strikers were down in September versus August. We know that claims were quite low. So if the reading is in line with that Bloomberg Whisper number, it wouldn't really surprise me too much. And, in the big picture of things, the last 3 months, Chairman Powell pointed out at the FOMC, was 150,000. The prior year was 430,000 for the same 3 months. So if it's not slowing fast enough for everyone, if it's not collapsing so we know it can only get better, I'm sorry. It's in a very gradual slowdown.
Two-part story, the data, how the market responds to it. TK hates this stuff, but we have to talk about it. Is bad news good news today?
Well, look, I think that there's been just tremendous apprehension. There's signs of capitulation. The Bloomberg's measures of market liquidity, again, have weakened for the Treasury market. Shorts look to be at record highs, but whether or not we can come to grips and change that trend on an employment data point, I'd be guessing to say. But it'll be fascinating to see the actual results.
I'm going to get to the profit picture, which you're expert at, in a moment, but I've got to ask you about the bond carnage we're seeing and folded into a piercing paragraph in your note. It's not the 1970s. Is it just simple? Is disinflation to the rescue?
Well, I think that you'll see measured disinflation in the CPI in the coming year, for sure, just like we saw it this year. I mean, we were at a peak of 9, we got to a low of 3, we're headed a little bit back up. But by the end of next year, particularly shelter measures are going to be much lower on the CPI readings. Now, whether or not this is satisfying everybody about the long-term inflation outlook is unclear. But yields here, again, where you take a look at real yields at 2008 levels, another period we had some difficulty with liquidity. If you believe the economy is slowing, this is satisfying. I have to say that the long end of the Treasury market with an inverted yield curve, it's counting on the Fed cutting rates. And that's what's been embedded for a long period of time. Just the mere fact that you're not collapsing the economy, the Fed is not shutting us down very hard, that's going to be hard to maintain that inverted yield curve, and that's part of the pressure here.
Right.
So it's really, again, much more of a normal rate than it is either 1970s or 2020.
The heart of my analysis, which goes exactly to what you've done for years at Citigroup, is to analyze corporate profits within the broader economic algebraic function. Great. My theory is the corporations will adapt like they've done before. Do you agree with that?
I do. And it's been a tough period to adapt. I mean, if you look at this past year, the rate of employment growth has exceeded GDP growth by the most since 1974. One of those really great years. So it's been an unusual period where labor markets have outperformed the economy. But that edge that the labor markets have, despite, all of the labor action, I think is receding. And the coming year, like jobless recoveries of the past, is going to see the labor market slow. I think output actually has a chance of gaining some steam, particularly over the next 2 years.
John mentioned Michael Hartnett over at Bank of America. He also said this: bonds should be the best performing asset class in the first half of 2024. This is partly predicated on the idea of something collapsing or being taken down, some accident, something happening in markets to cause some sort of downturn. Do you get on board with this?
It's hard to find this area of collapse. And, by the process of elimination, we find that there's all sorts of things are already happening now that make it hard to really generate a collapse. And, again, why? If the inflation rate is coming down, if we happen to have a low unemployment rate, is that enough for us to force a collapse on the economy? I think the Fed could collapse the economy if it really wanted to. When I take a look at the massive delivery of multifamily apartments that are coming, about 1 million that are still ready for completion. This is an issue. Do I see that as a larger issue than the larger geopolitical risks? No, I don't. So sector by sector, we go through this. Look at the ISM report, how the manufacturing sector has been contracting for a year. Trade across the world has been contracting for a year. Residential investment down over 20%. Is this just the beginning? I don't think so. I think we're going to be in another period very similar to the Fed's forecast, where the economy stays below trend, where it's absorbing, these losses. And unfortunately, but it's not this clear as day V-shaped decline in recovery.
So what I'm hearing from you is bonds maybe not so good, because if we could stay at this level and nothing breaks, then it's not necessarily a given that yields go down. And on the other side, you could see some of the stalwarts, the tech names, do all right, muddy through because they're growing revenues, but the rest of the sectors are going to continue struggling.
It's always wonderful when you could just say one asset class will greatly outperform the other, when the reality is that they're going to perform together to some extent. That if bond yields decline, there will be certain equities that do well, even depending on the reason that yields fall. But I think it's important to see that the bond market can still be a successful place to invest if you hold the maturity, if you hold bonds of 4 to 5 year maturities with 6% yields in the investment grade corporate market. This is going to be higher than the cash yield over that same period.
I know we can't do single names with you, but I've got to ask you about what's happening in the energy patch this morning. Exxon nearing its biggest deal since 1999 with Pioneer, based on the reporting from the Journal and according to a person familiar with the matter that we've heard from. When you wake up and see a deal like that, potentially $60 billion US for American oil, what do you take away from that?
I think OPEC deciding that it's going to decrease its market share and it's going to cut production more than the entirety of the rise that we have seen out of American oil producers, again, is providing value, soft landing, all of this to every Western energy producer. And if you want to talk about alternatives or conventional, we're building redundancy in the energy market, and it's benefiting everyone. And it means, again, a relatively higher price, but it's going to benefit energy producers outside of OPEC that they've done this.
Is it a sector you like then?
I think it's a sector that we think is going to be firm, that's going to be solid, and it's usually one we worry about in slowdowns. This is a case where I'm not worried about energy in a slowdown.
That's a big change.
Yes.
Walk us through that.
Well, the typical energy sector response to recession, and again, my view of recession is it's not quite that. It's a real slow patch. But the typical average recession, the last 4 times, the energy sector was unprofitable, right? About a 100% drop. And we're not talking about the special case of 2020 with negative oil futures and loss that was horrendous. But even all of these other downturns, you've seen oil plunge to the 30s, to the 20s, and you've seen unprofitable energy companies. And American producers have been cautious. They've been raising production very slowly and conservatively, and under those circumstances where there are significant supply risks around the world, Russia its oil exports are 6% of global consumption.
Yeah.
These things and OPEC cutting, all of these things together, has really arrested the decline. The energy sector is not going to suffer the kind of losses and a slowdown that it has in the past.
Hey, Steve, it was great to catch up.
Thank you.
Steve Whiting of Citi on Payrolls Friday on the potential there for a big deal for U.S. energy. From New York City, much more still to come on a payrolls report. The estimate 170,000 in our survey here at Bloomberg. Coming up through the next hour, Priya Misra of JP Morgan Asset Management. Do not miss that conversation. From New York this morning, good morning.
all eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labour market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, today on Bloomberg Television and Radio.
The second area that we think is really attractive is energy. This is really, again, it was the darling last year. It is actually at a very, very important technical level right now. If you look at a variety of different things, whether it's XLE or other variables, we are sitting at some really key levels. So understanding what we look into earnings season for energy market is still that discipline from corporations. They've really been forced to by shareholders. So energy is interesting.
Energy is very interesting this week, that's for sure. Eric Friedman, CIO at US Bank Asset Management. Crude, the underlying commodity, heading for the biggest weekly loss going all the way back to March. Speaking of deals, according to reports here at Bloomberg, the Wall Street Journal, Exxon in talks to acquire Pioneer Natural Resources, potentially for $60 billion US dollars. More on that in just a moment. Let's turn to the price action. This payrolls Friday. The estimate at the moment, 170,000. Equities on the S&P 500, slightly positive by 0.3%. A little bit of a lift here. Yield high by a couple of basis points, 473.81. But what a turnaround in the oil market. All the way back down. TK to 82.53. Slightly positive this morning, very negative on the week.
It's going to be interesting to see. And the major thing about it here, coming down from the 100 level, 90, whatever it was, down to the 80s here, is not so much that we came down, but it was the speed of it. And a lot of the research I read, brings it right over to gasoline demand. And Ben Laidler with a brilliant note this morning saying, look, gasoline makes up 3% of the inflation pie. So I got the politics of it, which is OMG, gasoline's going up, crisis and all that, versus the reality that we're nowhere near hydrocarbon dependent like we were in my ute when my father was driving around with a VW Rabbit.
Producing close to 13 million barrels a day in this country.
Do we understand that we're Saudi Arabia? I mean,
I remember a program, Bloomberg Surveillance, maybe 10 years ago when you called us Saudi America. Remember that?
I said that?
You said that.
I don't remember.
I remember that a long time ago.
Amrita said remembers a long time ago. She looks at the geology of the Permian Basin and is expert on it. We're not going to do securities analysis here. We'll save that for another conversation on this important $60 billion potential transaction. Amrita said of energy aspects as well. Amrita, the stereotype of America out from Lubbock past Midland to Odessa onto New Mexico is 1924. There's oil in them, there are hills, and we went out and find it. That's the stereotype, the movies, James Dean and all that. Forget about it. What's the new stereotype? Why does Exxon want to span more oil from Lubbock to New Mexico?
I mean, look, you can see that from U.S. shale production. As you guys were just talking about, production has been rising close to 13 million barrels per day today, and it is still projected to continue rising. I think what we have seen, however, the last decade was very much about quantity over quality, right? Every CEO was incentivized to grow production and not return money to shareholders. And that's changed dramatically. And what you are seeing today is very much like slower growth, consolidated growth, and we've seen an enormous amount of M&A activity. Companies want to take over adjacent acreage, and they're getting more efficient. The number of M&A deals, we put out this piece a few months ago identifying 80 companies that could be taken over. 15 of that's already happened. And one of the very interesting things, Tom, you're seeing that is if, say, a company acquires another company, they are not continuing to run those rigs. 1+1 rigs is basically now becoming 1.2. They are getting rid of the poor rigs, and that's one of the big reasons why U.S. production growth has slowed.
We'll talk about the synergy memo starting to come out. Our Citigroup with a lead memo this morning. We'll do that later. Amrita Sen, I look at this, and it's number 2 and number 4, and of course we hearken back to Occidental taking out ginormous and wonderful Anadarko. Okay, fine. Are we consolidating the industry into a duopoly, a triopoly? Are we taking the independents out?
No, the independents are still there, but what we are taking out are tons and tons of the mom and pop shops effectively, very, very tiny producers, private equity owned assets as well. What you are going to have is a much more efficient shale patch that actually produces good quality and at a cost where shareholders are happy. Like I was saying, last 10 years, they just grew production and nobody returned any money to anybody, which is fine in a zero interest rate environment, but that's not fine when interest rates are 5.5% or 5-6%, depending on which part of the curve you're in.
Amrita, how much is this deal also fueled by this idea that people are realizing that fossil fuels aren't going away so quickly, and that, if anything, they're going to be needed at all times, even during the transition to different types of energy?
I mean, I hope that is the realization. I just got back from Abu Dhabi this morning. I was there for ADIPEC. And I think in the region, it's very much the main focus, saying that, look, yes, we need to decarbonize, and something we've talked about, right, on this show, that let's talk about decarbonizing hydrocarbons. Let's not talk about not having fossil fuels at all. Because if economic growth continues, population growth continues, what will happen is energy demand will grow. Those are like the basic truths. And if energy demand is going to grow, we're going to need all forms of energy, because we're not even investing enough in renewables, let alone in fossil fuels, to meet current energy demand, right? And that's the realization, hopefully, that's sinking in the West as well. The East gets it. It's much more for America and Europe to come around to that.
Meanwhile, we are looking at oil prices that have been on a wild ride. We saw them climbing. We were talking about $100 a barrel, and suddenly we saw the biggest decline this week, going back to March. Mm-hmm. Do you view this as too far, too fast, the way that Barclays does, or do you see this as something fundamental, especially in light of what we're seeing in copper and other commodities tracking this type of decline?
No, I don't think this is fundamental. It's really been positioning driven. Open interest in options markets have been very high. The macro backdrop, you've had treasuries rise consistently for a while now. Oil had decoupled, but it's definitely come back under kind of the macro scrutiny. Purely on a fundamental basis, look at the backwardation. Look at the front month versus the second and third month. That is extremely steep still, whether it be WTI, right, whether it be Brent, whether it be Dubai. It's telling you that the physical fundamentals are absolutely fine. You get flush outs like this, and you don't get $5, $10 moves on fundamentals. That tends to be positioning or geopolitical driven, right? We'll get through this, and once we rebase, we will continue to move back higher again. But you'll always get, we'll never go up in a straight line. When I was in the studio with you guys, I was saying that as well, right? You'll get some consolidation and volatility, and then we'll go up again.
Amrita, quickly here, going back to Adam Szyminski and Paul Sankey at Deutsche Bank a million years ago, there's the Amrita Sen's spreadsheet, Excel spreadsheet of demand. Which is the single line item of demand flexibility or movement that matters into November of this year? Which geography, which kind of oil signals to you where demand's heading?
I would say right now it's going to be the US, because that's where all the macro worries are. That are we slowing down significantly? Is it a collapse? I completely don't buy the gasoline demand print that came out of the EIA this week, but that's what we'd be focusing on the US gasoline, US diesel story. The rest of the world's okay. We know where it's headed. It's the US where the uncertainty is.
For people who just caught that line, Amrita, what do you mean you don't buy it?
I don't buy it because you don't get that kind. Okay, very simply, you can look at how much ethanol is being used in gasoline. You can back out gasoline demand from the ethanol usage. That still says it's close to 10 million barrels per day. The weekly EIA numbers are all over the place. They've never been too reliable, and off late, definitely not reliable. So I wouldn't pay too much attention to that.
Friday morning, inorganic chemistry with Amrita Sen.
Amrita, appreciate it. Just quickly, I've got about 30 seconds. Triple-digit crude by Halloween. What's the call now?
I'm going to stick. It's a better call now that we're at 85 rather than when it was at 95. So I have to stick to that.
Okay. We'll speak to you around Halloween. Amrita, thank you.
She's getting
Amrita Sen of Energy Aspects. Appreciate
interview.
it. Well, a couple of weeks ago, it was triple digits by Halloween. Apparently, it's still triple digits by Halloween.
Mark Keller, the giant of A.G. Edwards' cautious conservative investment, once told me that the guesstimates and forecasts of American nat gas were a direct correlation with the temperature of the subway stop on Wall Street.
I remember hearing that. Coming up on the programme, one of the greatest lines I think we've heard over the last couple of months. Really poignant, really fundamental to the conversation we're having. Sarah House of Wells Fargo on the last mile of the inflation effort. That conversation coming up on this Payrolls Friday. Your estimate, 170K. Your payrolls report a couple of hours away. From New York, this is Bloomberg. 2 hours away from the payrolls report. Here's the price action this Friday morning. Good morning to you on the S&P, on the Nasdaq, the Russell. Small caps firmer, higher by 0.5% on the Russell. On the S&P 500, up around about 1/3%, poised potentially for a 5th week of losses. Let's see if we can turn that around with the jobs report a little bit later. On the Nasdaq, we're firmer here by 1/3%. In the bond market, 5 consecutive weeks of yields higher on a 10-year maturity, up another 2 basis points this morning to 4.74. It's quite a turnaround in this bond market, isn't it? Breached 5% briefly earlier on the week, back down to about 4.90 on a 30-year. 4.91, up 2 basis points. The 2-year holding on to that 5 handle, 5.04%. Yields higher here by a couple of basis points. Let's turn to foreign exchange. Keep an eye on this one. The euro against the dollar. The euro is negative on the week, just slightly, by about 0.1%. It's up on the session, just slightly, up by about 0.1% against the dollar. So here we are at 105.60, facing the real potential of 12 consecutive weeks of euro weakness, Bramo, against the US dollar. That is a record weekly losing streak already. We could well add to it later.
And that raises a question, what will it take for the euro to rally, given the fact that that region is really facing so many more difficult sort of recipes than the US? And we've seen the strength. Today's jobs number, if it comes out strong, what does that do to the euro?
Well, that's the next step.
To the bond market after what we've seen already this week, TK.
What's so important here, folks, and this goes to the correlations across equities, bonds, currencies, commodities, is, whether you're going up on the vector or down, we're out on the edge of the range. And I don't see research being written of the what if Lisa alludes to, what if we expand beyond to euro 102, to yen 151, bring it over to all the other elements as well. We're at that range point as we go into this jobs report.
Already had a little look at 104 in the last couple of weeks, back to about 105.60. Under surveillance this morning, the US jobs report coming out in about 2 hours' time. The median estimate in our survey calling for a 170K print with a range of calls from Wall Street's biggest banks. Andrew Hoddenhorst over at Citi looking for 240. Our next guest, who we'll speak to in just a moment, Sarah House of Wells Fargo, looking for 150. Look out for that one a little bit later. Exxon nearing a takeover of Pioneer in what could be the company's biggest acquisition since merging with Mobil in 1999. The deal could be worth as much as $60 billion and may be finalized in the coming days, according to the Wall Street Journal. Lisa, you put it all together, the combination, Pioneer and Exxon, we could be talking about the biggest oil producer with an output of about 1.2 million barrels a day, comparable with some OPEC plus nations, which is just absolutely phenomenal.
From a policy perspective, does the U.S. administration like this? I mean, you have to wonder, on one hand, there's a whole antitrust push, especially by this administration. On the other hand, if you can truly compete with Saudi Arabia at a time where oil prices, gasoline prices are a key component of, the election and of consumer prices and how people feel, and you could potentially lower prices and make it more efficient, well, isn't that kind of a welcome thing?
And that's what Citi's talking about this morning, TK. I know if you've read that note, the prospect of economies of scale in a place where you might need it.
I don't want to go into it now. We'll do it later in the show. We got Sarah House coming up. But the bottom line here, folks, is the pros are moving the numbers around, and we will bring those to you, what Global Wall Street wants to know, which is the synergy effect. I make fun of the word synergy, except in this case it really matters, because the adjacencies of these oil fields, I'm told by experts, are not all that tight. So there's a mystery, according to Scott Gruber and his team.
To your point, I think we're both on the same page with synergies. Usually fancy speak for people who are going to lose jobs, which is why we both hate it.
Yeah, but within the manufacturing process of hydrocarbons, there's a template for how they do this. And it's not just Occidental Anadarko. It goes back years and years. I was weaned on something called Callon Petroleum in the Gulf of Mexico. The bottom line is it doesn't matter. There's a formula in hydrocarbons for doing synergies.
Let's finish on this. Here's the latest down in Washington, D.C. Shortly after leaving office, former President Donald Trump allegedly sharing classified information about U.S. nuclear submarines with Australian billionaire Anthony Pratt at Mar-a-Lago. This according to ABC News. Pratt then went on to share the information with several others, Tom, including foreign officials, his own employees and journalists. The latest reporting this morning.
We will get James Stavridis on, the Admiral, at some point. We're not doing that this morning, but we will get there. John, I had a brief lunch with 3 submariners on my deck this summer. These guys are in metal tubes, underwater, under stress, and we're giving away secrets on these guys' lives and secrets.
Can you explain to us how a lunch like that comes together?
Comes together because one kid a brave Filipino said, I'm signing up, and he had the audacity to re-sign up a second time.
Okay.
And re-sign up a third time. And he's going out of Groton. It's all secret. They can't tell you where they're going, where they've been. It's all one big secret thing. But I just want to suggest that this is not Washington Beltway garbage. This is physical assets with real people on board.
Putting aside the politics and whatever people think about this exact issue, there's also a question, especially as some of these issues percolate out, that are international and in foreign relations concerns for some of the allies of the U.S. I do wonder how that's going to complicate things. Janet Yellen's heading over to the IMF meetings in Morocco. I know, Tom, you're going to be there, but my question, John, honestly, is how much of a concern does this raise with information sharing, et cetera, from other nations with the United States?
We'll catch up with James Lucia, I believe, of Capital Alpha Partners, senior political analyst, Tom, on some of these issues. We'll do that in the next hour.
Yeah, we'll have to see. I mean, it's that simple. Let's go to the jobs report right now. We're going to dive into this with someone expert, Sarah House, senior economist at Wells Fargo, with a much more tepid view on job formation in America. There's a standard error. There's the error of the standard error, Sarah House. What is your confidence going in on 150,000 statistic?
Well, I think given all the cross currents and just how wild a period we've been in, I have to admit the confidence level isn't quite as high as maybe it has been in quieter times. But I think when we step back and we look at the overall labor market, we do see momentum slowing down and the labor market cooling off as we have increasingly less scope for catch-up hiring from the pandemic, and we're continuing to feel the weight of tighter monetary policy.
What I see, Sarah, here is the effect of small business. I get ADP, and Mike McKee parses it out on that. In the jobs report, in the two surveys, is small business represented?
It's certainly represented and it's included, but it is admittedly hard to parse out within the actual employment situation report. But we do get some nice data coming from the NFIB on that. We got a little peek at what they were looking at for September. And what we saw there is, hiring plans roughly stable. So by far down from what we saw at the peak of this cycle, but roughly back in line with where we were in 2017. Still difficulty filling positions as well. And so small businesses are still out there looking to hire, but it remains a difficult jobs market for them.
So do you still have concerns about the last mile, or do you think that the pace that some of the weakening is happening is enough to get us back down to 2% without the Fed doing that much more?
So I think we have seen some pretty marked progress on the inflation front, and I think the 2% inflation is a little bit closer than I might have imagined, 6 months or so ago. And I think the labor market has been a big part of that story, where we've seen a large influx of supply, and I think that's helped cool the wage pressures. But I still think that last mile, so to say, is going to be more difficult, and you are going to see more softening in the labor market. So that's where that pain comes from. It's not that we can't get to 2% in a timely manner, but I think it is going to take a larger slowdown in growth and more deterioration in the labor market to squeeze out that last percentage point or so of inflation relative to target.
You said you've been surprised by the pace of some of the disinflation, and that you actually have been pleasantly surprised at how much this and how quickly it's going. Does that mean that you also think that the unemployment rate is going to climb more than you previously did, and significantly more than the Fed's expectations of about 4.1%?
Well, we do think the unemployment rate's going to climb more than what the Fed has penciled in, but maybe not quite so much as where we were a few months ago, just given, again, that really impressive rate of rebound in the labor force participation. And it does seem like workers are coming back into the labor force at a stronger pace than perhaps feared. And so that's taken some of those wage pressures off. But I still think that there's more scope for the unemployment rate to move higher, just given the downward momentum that we see in hiring and the fact that you do have a larger labor force base to go on.
Sarah House, a thankless task, but we're going to go with it on a Friday. I want you to conflate this jobs report into monetary economics. If we get a single point, 145 to 150,000 non-farm payroll, what does that do to the bloodbath, the carnage in the bond market, over to what Chairman Powell's choice set is? Does your call today move the Fed if you get it right?
So I think when we look at the jobs market print today, I think if you do see something along the lines of what we're looking for, even consensus, I think that does point to that continued moderation in jobs, which has thus far been in a pretty orderly manner. And so I think you do need to fold that into some of the other data we've seen where, you know, obviously we focus so much on jobs, we focus a lot on inflation, but I think just given everything we've seen in the bond market over the past few weeks, I think that has to be folded in too in terms of that financial conditions tightening where to some extent maybe today's jobs numbers matter less, and that data that the Fed is looking at it also has to be folded in terms of that financial conditions.
Mike McKee emails in, he says, ask her about UAW. You got to help Mike McKee here. You know, he's going to do this at 8:30 this morning. Is UAW play into this, or is this next month's report?
That's next month's report. So the strike began partially through the survey week, so those workers were working for part of the payroll week. So we really need to have it go through that next survey week, which I believe runs from October 8th through 14th. And remember, though, it's not just the striking workers that would at least get knocked off those payroll numbers for October's if we see the strike extend, but it's all the workers that have been laid off in relation to that strike as well. So there's the two-prong effect of both the actual striking workers, how that feeds into areas in terms of like the household survey versus the payroll survey, but also those laid off workers, which I think we have to factor in terms of that moderation in the coming months as well.
How much, Sarah, are we seeing just a skills mismatch where we could see potentially wages continue to accelerate even as the unemployment rate goes up, even as there are layoffs of certain types of staff?
I think that's part of it in certain sectors. You know, if you look at the construction sector, so that's been an area we're continuing to see pretty decent hiring, but that sector's really had, I think, chronic labor shortages just from the skills mismatch and not seeing as much of those vocational trades. And so I think that's a persistent issue in some of those skilled trade issues, but I'm not thinking that that's a big part of the overarching tightness of the labor market. And I do think just as you continue to see demand slow, we'll see those pressures come down, since I think the skills mismatch is pretty limited to a few sectors and industries.
Sarah, thank you. Sarah House there of Wells Fargo on the jobs market going into payrolls. That report just around the corner. Their estimate over at Wells, 150. The median in our survey, 170,000. If you want to know what the prediction is for unemployment, looking for that to fall back from 3.8 to 3.7. Citi, top end of the range, looking for 240,000 for the headline number. Looking for unemployment to come back down to about 3.6. Going into all of that, equities slightly elevated on the session, down slightly on the week. On the S&P, positive by 1/3%. On the S&P 500, yields higher by a couple of basis points. The prospect of 5 consecutive weeks of yields climbing on a US 10-year yield, 473.60 over that period, up by around about 60 basis points. And an important conversation that Abramo had yesterday with the San Francisco Fed President, Mary Daly. Lisa, is that a replacement for the potential of one more hike from this Fed this year?
She said potentially yes. If things stay at this level, that all things being equal, the bar to raise rates is that much higher. And it could replace essentially a rate hike, so it could keep them on hold for longer. It sort of speaks to what Sarah was talking about, where financial conditions tightening is something they take into effect. Rich Clarida saying something very similar. The bond market's doing the work for them. She leaned into that. She's a non-voting member, but she leaned into that idea.
Did you get the feeling she thought this was orderly? She thought the way we've repriced is okay?
Yes. I got the sense that she's seen nothing disorderly that should get her attention. It didn't seem like anything was breaking to her. And what I find interesting about that is some people will find that disappointing. Michael Hartnett, for one, among others, looking for something to break. She doesn't see it.
Yeah, I think break is an operative word here as people, you know, obviously institutions are going to try to perform a controlled, a calming force. Daly's very good at that. But yeah, there's some real emotion here about break or jump condition. That'll happen at 8:30. We'll just have to see what the date is.
Up next, a piece of Lisa's conversation with the San Francisco Fed President, Mary Daly, at the Economic Club of New York. Live from New York City this morning. Good morning. Equities positive by 31%.
I do think something has cracked, and for the first time in my lifetime, people are actually questioning the trajectory of where treasuries are going to be, and that is very concerning to me because every financial bubble that we've ever had has always come when it's a safe asset that breaks. The ability for markets to move very quickly is very high.
That was Peter Chu of Academy Securities. Just absolutely fantastic. A clinic on fixed income yesterday. Some of the concerns he has out in the distance and why he's bullish near term. You try and make sense of that when you listen to it on Bloomberg.com and on the Bloomberg terminal. Let's turn to some of the price action for you on the S&P 500 on this payrolls Friday. A lift here, up 1/3%. Yields higher as well by a couple of basis points, up 2 basis points to 473.60. In the FX market, on the week, the euro is negative 0.1% against the dollar. This would be week 12 of euro weakness against the US dollar, 105.60. We're trying to do something about that right now, up on the session by 0.1%. This one could turn around with the payroll story, the estimate 170,000. I want to talk about this story as well, Exxon and Pioneer. The Wall Street Journal reporting overnight the prospect of a $60 billion deal. According to a person familiar with the matter, Exxon in talks with Pioneer Natural Resources. TK, Pioneer up by about 11% this morning. Exxon down by close to 2%.
Yeah, synergies. This is all about scale. We've talked about it. And let's be clear, this is not a great zombie roll-up. This is a hugely profitable company. You mentioned it earlier, Mr. Sheffield is looking to exit, to retire. And what I find fascinating here, and it's an Allarian thing, the game theory is not pretty. How many people out there can actually buy Pioneer? You're not going to sell it to the Saudis. That's politically not acceptable. What's the choice set of people he can unload this puppy to? It's a small group.
Well, speaking of the people involved, Tom, we've got Darren Woods over at Exxon looking for a dance partner, looking for something to buy. You've got Scott Sheffield over at Pioneer looking to retire.
Yeah.
The timing of this works, doesn't it?
The timing works, and I haven't done the actual cash cost here, and we'll get into the synergy in a bit. We've got some other things to deal with. But the answer is it's pretty cookie cutter. It's a different industry. It's not like, General, what was it? The merger, they bought Wella Balsam in Europe, Procter & Gamble.
Right.
Bought shampoo in Europe. You know what? That's a little bit marketing and squishy, and, will they buy the new Irish Spring soap? This is much more cookie cutter.
This is different. I'm with you. And it comes at a time where crude has had a really difficult week. On the week, WTI crude is heading for its biggest weekly loss going back to March. Much more on that a little bit later. I want to talk about this bond market, Bramo. Yields at the moment on a 10-year, higher by a couple of basis points, 474. What a week it's been for the bond market. And a big question, what does it mean for this Fed?
Especially because you have seen it, and what did feel disorderly for a minute, for a hot second, and now we've sort of repriced and stabilized, and yet we're still at 4.74. That to me is sort of shocking. I don't know. I was yesterday speaking with San Francisco Fed President Mary Daly at the Economics Club of New York, and she talked about this. She basically said that if yields stay at these levels, it essentially would be the equivalent of a rate hike and might remove the need for them to do anything. She also talked about banking stress, the commercial real estate market. Take a listen to part of our conversation.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there. So from my own perspective, that's what I look at. That my job as I see it, our job as I see it, is not to tighten, just do our part. It's to watch financial conditions, because monetary policy works. We raise the funds rate, and it moves through all the other interest rates. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Yeah,
does that make sense?
Absolutely. And Rich Clarida said today that the rise in yields actually does the Fed's job for it. Would you agree with that? Would you sympathize with that kind of sentiment?
That is actually how it works, right? If financial conditions tighten, one of the things that's happened in the last 90 days and certainly in the last few weeks is that financial markets have collectively seemed to take on board a variety of things. But one of the things that I heard from many commentators and many of the market outreach I do is that they have a general understanding now that we are committed at the FOMC to keeping rates higher for longer in an effort to bring inflation fully back down to 2%. And that recognition, along with all the other factors we could put in a list about why bond yields have risen, are affecting certainly the financial conditions and the tightening. And I see that as a positive outcome, that we would have tighter financial conditions, because then we can really get the job done of putting inflation back to rest.
Back in March, when there was this concern about the banking situation, yields were at the low of March, were about 150 basis points lower than where they are now. Are you seeing the same type of financial distress today that you did back then, even on the peripheries? How do you rationalize why it hasn't materialized in the same kind of way?
So March was a unique situation, and we want to learn from that unique situation, but it was a unique situation in this way. We had a bank run, a very old-fashioned but true bank run, where the bank's liquidity was completely squeezed, and it dissolved in a period that was it was short, rapid period of dissolution. And then that spilled over to 2 other banks. And that was the extent. Now, one of the things I always remind people of is we have over 4,000 banks in the country, and 3 failed. And all other banks that even felt the stresses, and there were a large number that felt stresses because they were near neighbors in sort of size and balance sheet distribution, composition. They felt stresses, but they managed those stresses. Since that time, banking stresses have really not been something that when you ask people in the community or the business leaders, what are you top of your worries? That is not something they list. They list inflation, uncertainty, etc. So I think one of the reasons that we are seeing this yield rising not spilling back over is that essentially, we know what's going on in the banking sector. Investor letters have been published for months saying, here's what this balance sheet looks like, here's what this balance sheet looks like, so there's not a surprise. And the second is because the banking system is safe, sound, and resilient.
People talk about a Fed put. How high is the bar for the Fed put? How high is the bar for financial distress, for the Federal Reserve to come in and to cut rates and to take actions to add liquidity to the system? How much higher is the bar at a time where inflation is still running at the levels that it's running?
I hear a lot about the Fed put and this. What I really would do is we have tools that can be used, and the tools we use for financial dislocation are different than the tools we use for monetary policy, and both can occur. So we shouldn't have to give up our promise to the American people, our commitment to achieve our mandated goals and bring inflation back down to price stability because we have some dysfunction in the markets. But I, right now, don't see dysfunction.
Timely conversation with the San Francisco Fed President Mary Daly alongside Lisa Abramowicz at the Economic Club of New York yesterday. Catch the full conversation on Bloomberg.com and on the Bloomberg terminal. 2 parts to that conversation. 1, what does the sell-off in treasuries mean to Fed policy? And 2, slightly connected, the dysfunction we've seen in the financial sector over the last year. Let's pick up on the banks, Bramo. San Francisco and that Federal Reserve at the heart of what we saw play out earlier this year.
And she's basically saying, this was a very specific situation. There are only 3. But she also talked about the program that they put in place where they can basically take treasuries on their balance sheet and relieve them and relieve banks of the implied losses, the mark-to-market losses of those securities. That is allowing the lack of financial distress at this point. So at what point, are we looking at something that is essentially being supported by Fed policies to this day because of some serious mark-to-market types of changes in the market?
That's a key point. I'm going to give a major slack on data dependency. I know I'm an outlier here. You two think they're supposed to be more omniscient. But the fact is the facts have changed. And all of them are going to be diving into mark-to-market versus non-mark-to-market losses, a myriad of themes there that they have to guesstimate as they go to the November 1 meeting.
Well, let's put that together. The unrealized losses have got greater. But ultimately, because of the policy response earlier this spring, Lisa, are these banks, this system, well insulated to that, despite what's happened over the last couple of months?
That was the implication. That was the implication, that there's not necessarily any evidence of financial distress that would cause some sort of cascading effect. And, she does talk about how they do have, surveillance and they do oversee everything. Right. What I find interesting is at what point do some of the tools that the Fed use, do they kind of have a stimulative effect in a sort of de facto way because they keep things from breaking the way that many people think otherwise naturally would happen?
It's 6:55. Can we digress away from the stories, the exhaustion of this
What would you like to discuss?
For those of you in America, this doesn't happen except in the world of John Ferro. He will now describe it here. Kenilworth Field, 11,000 people. The Tot Stadium, which I've been in, 62,000 people. Only in your world do the Tots travel to play at Luton.
Do you want to go to the game?
Of course, I tried to get tickets. Levy said I'm not on speaking terms with you.
I can't explain that in about 10 seconds, TK, but it's phenomenal to see them in the Premier League.
This is history.
From New York City, this is Bloomberg.
it feels like something's cracking.
I think it's problematic for the equity markets that you're having such convulsive moves in the bond markets.
These higher yields are starting to spread into credit.
We are not calling for a recession. We think that call is premature.
The economy is not going to be able to handle these rates, but the Fed is going to be the last to admit that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive by 0.2% on the S&P 500. It is all about the payrolls report in the United States of America. The estimate right now, TK, 170,000.
Really critical, and of course the overlay here, the bond market is substantial. We're going to report on that. John will do the data check here in a moment, but I'm sorry, the data this morning continues to show stress in the bond market. This is a different jobs report because of what we see in fixed income worldwide.
The data, 90 minutes away. Lisa, the range, 250 at the high end, 90 at the low end.
It's so funny to me that we trade so significantly on different misses or beats on these particular data because it gets revised downward or upward by 150,000 every other month.
Are you spoiling Payrolls Friday?
I am going to spoil Payrolls Friday. I mean, this data gets revised, so people are looking for a signal at a time of incredible uncertainty that everyone's uncomfortable with. Nobody likes uncertainty, and so that's where we're at right now.
Are you stepping aside and taking the rest of the morning off?
Yes.
And skipping payrolls?
See you later. No, kidding. No, I'm going to be here, and I'm going to parse through it, and I'm going to explain why it suddenly is important at 8:30 a.m.
Can't wait for that, Lisa. Real turnaround from Bramo in about 90 minutes' time. Let's talk about this equity market. Futures look like this morning, positive by about 0.2%. Yields are higher by a couple of basis points, 474.43. Tom, to see the euro facing a 12th week of weakness against a stronger dollar.
Yeah, and as you mentioned, there was a 104 print earlier, and I was going to say, John, people are modeling out 102 or even parity out to 0.95, but to 1.00, but what I would suggest is we don't know on the Bloomberg Launchpad what's going to move next. I would just assume, and I think the media is really caught up to what we've said all week about price. We're going into this jobs report looking at equities, bonds, currencies, analysis in a completely new way in fixed income, price-based.
Missed an asset class, commodities, so let's talk about it. Crude this week, potentially the biggest weekly loss going back to March, but we're getting some deals done. Potentially, between Exxon and Pioneer. According to the Wall Street Journal overnight, the potential for a $60 billion deal. Pioneer, Tom, positive in early trading by 12%.
Thank you. I didn't know there was a 12% pop. I've seen model out a 15% pop, so that 12% makes a lot of sense.
Exxon down about 1.6%. Much more on that story through the hour. Some fantastic guest lineup. Priya Misra of JP Morgan Asset Management are with us around the table to break down this bond market. Ellen Zentner of Morgan Stanley later on this hour, Bramo, to talk us through payrolls.
I'm so looking forward to that and just to understand the importance of this. And Priya Misra, her first interview after moving jobs, I'm very pleased to say. 8:30 a.m. U.S. jobs report does come out. We will parse through the numbers. It is very important. I don't really want to diminish it. However, I do think that the revisions have raised some questions about how much we can bank on one print, ADP, for example. The market still will. Unemployment rate is expected to go, say, at 3.8%, but the market expects 3.7% decline. 9:45 a.m. This I really am looking forward to. The U.S. Acting Labor Secretary Julie Su is joining Jonathan Ferro on Bloomberg Television, and I really want to hear what she has to say about parsing through the power of labor, wage increases, and the tax on the broad consumer of inflation and pairing those kinds of ideas together. And at 3 p.m., U.S. consumer credit for the month of August. Consumers have been fueling a lot of the recovery. And at what point are they doing it on debt that is in an unsustainable fashion? And that's the reason why, to me, the revolving credit, the credit card debt, is going to be really interesting.
Lisa, thank you. With us around the table. Been looking forward to doing this. Priya Misra, Portfolio Manager at JP Morgan Asset Management. Priya, congratulations on the new seat. Welcome to the program.
Thank you.
I want to go back to a call you made earlier this year. The yield curve inverted for the whole of 2023. We've had some real steepness kick in over the last couple of months. Is that still the call for you through the year end?
You know, I think we can stay inverted. I do think that the steepening has been sort of a very interesting type of steepening. It's been bear steepening, which means rates have risen, led by the long end. I think it's a very dangerous sort of steepening because the long end is what ultimately the economy depends on. I think the fact that this has been a real rate-driven move, I think the bear steepening actually makes a hard landing much more likely. I do think the curve is going to keep steepening. Whether it steepens between now and year end, we're just talking 3 months. We might stay inverted, but I think at some point the curve is going to have a massive steepening when the Fed finally realizes between the bond market, between what the Fed has done, between QT, the Fed is continuing to tighten, it's going to tighten financial conditions to the point where the economy does head into a hard landing. So I'm in the hard landing camp. I know the economy's been strong, resilient, and I would argue it's because we don't quite understand the lags. I think the Fed's been saying that the lags are shorter. I actually think the lags are much longer because we had COVID savings. We also had essentially locked in our mortgage at a very low rate. At some point, people have to move homes or that savings runs out. That's when the consumer starts to slow down. I think you get that big steepening once the Fed starts to signal rate cuts. I don't think that's happening anytime soon, though.
That's a different kind of steepening. That's the bull steepener.
That would be a bull steepening, exactly.
This has been the bear steepener. You used the word there, and there's tons to unpack. You said it was dangerous. What is it that you think is underpinning this move at the long end? Not the consequences of it. What do you think is underpinning this move at the long end?
That's a good point, because I think a lot of people are saying that it's ultimately supply. We've had Treasury supply for a long time. I actually think it's the buyer stepping away. It's not that there's supply. I mean, we have a long-term debt sustainability issue in the US. But why have the buyers stepped away? I think the buyers have stepped away because we heard from the Fed loud and clear, higher for longer. Mm-hmm. The Fed signaling that the bar to cut rates is actually very high. They want to absolutely make sure that inflation is down, that inflation expectations don't get unanchored. I think that September Fed dot plot, it was a very strong signal that the Fed wants real rates at 2.5% all through next year. I think that's what the market heard. The buyers stepped away. And I think that's when the supply narrative, which is why it's been a long end, 5 to 30 year sort of move.
Bob from Park Avenue emails in. He says, do some math, Tom. Let's do some math pre and mid. You nailed this inversion. We went in 2021 straight down. We're at 3.1 standard deviations. Basically, we've never seen this train wreck. We've gone from 106 basis points of inversion to 30. And what everybody wants to know from you is the path forward, linear or nonlinear? Is it within stability from 30 on up? Or is this now where the really heavy lifting clicks in that can affect the economy?
So, I'm going to say it depends on the data. Given that the data is slowing down really slowly. Now, I think recessions are always nonlinear events, meaning when it slows down, it's going to slow down really fast. I'm not sure today is the day. So I think we can stay around this minus 30, perhaps get close to zero. To get to that plus 100 basis point steepening, plus 200 basis point steepening, I think we need to see signs of recession.
But what people want to know is what's the path from negative 30 beeps out to negative 20 beeps? What is that? What's the ramifications of that for the fixed income market?
I think if it happens in a bear move, I think that's much more negative, not just for fixed income. I would argue it's negative for credit. It's negative for every risk asset. I think it's been a treasury market move. It's going to morph into a risk asset driven move. Mm-hmm. When risk-free real rates, and I'm going to argue it's the real rate component that's much more dangerous, risk-free real rates rise that much, I think you have to reprice risk premiums across the risk asset spectrum. So I think we'll be watching at all risk assets now.
So you're a bond bull. You've been a bond bull for a long time. We're looking at the sustainability of 4.74% on a 10-year Treasury yield. What could you see in the economic data that would make you rethink whether yields really will come down as aggressively as you believe?
So our risk scenario, which we've been debating a lot, and you can imagine the last month debating it even more. I would say signs that R-star or neutral rate, I was trying not to geek out on R-star, but if there's signs that long-term productivity is high, that the supply side effect is here. So if you get another big increase in participation today, if you start to see, population growth of the labor market or productivity numbers start to rise, then perhaps there's been some structural shift. I think that's the big debate we've been all grappling with all year. Is the consumer resilient because the lags are longer? Or has there been a structural shift in the labor market? We've become more productive, AI or some reason, and so we can actually handle higher real rates. I'm not convinced we've seen anything in the data on that front, but if we start to see that, I think we'll question what is true level of restrictiveness. I think I would argue 2.5 is very restrictive on real rates, but perhaps we can handle it if there is this essentially this sort of structural shift in the labor market.
Do you buy the idea that if that is truly the case, that risk assets can hang in there? Or do you think that eventually, even if there is this increased productivity, that you cannot have 20 years of zero rates suddenly just easily morph into a new era of higher neutral?
Exactly. And you have to think about risk premium essentially as well. So I hear your point. If we're more productive, maybe risk assets are okay. But how much should I get paid up for the uncertainty? If Treasury risk-free 10-year Treasuries are giving you 5%, perhaps I want 9% to take on credit risk. And that's where high yield is. Maybe I want 10%. So I do think there's going to be, even if it is a productivity-driven move, which means that that's going to be the new normal, well, then every other risk asset should be pricing in the fact that treasuries are more liquid. I also worry a little bit about liquidity risk. It's never appreciated until times become volatile like they are right now. You've got to pay up for that less liquid asset.
Let's talk about demand. You said that the buyers have stepped away. Can we discuss the sources of that demand and how temporary you think that is? Dilip Singh of PGIM talked about the loss of maybe predictable sources of demand. China. Things happening elsewhere. The Federal Reserve, for instance. Do you think we need to think about the character, the shifting character and personality of that demand? Has that changed?
Absolutely. So I think whether you think about the Fed or the central bank community, or I would argue the U.S. domestic bank community, they're sitting on massive unrealized losses. U.S. banks were significant buyers of treasuries. Who's the marginal buyer? I would say it's asset managers. And asset managers might be able to take a view here on rates, but they are also a function of inflows and outflows. My biggest concern right now is, do we start to see outflows from bond funds? Bond funds had massive inflows this year. I would argue, maybe I'm biased being at a bond fund, that there should be more inflows, because if you're looking at the fact that the risk asset complex is finally paying attention to interest rates, maybe you should have some treasuries or bonds in your portfolio.
That's the pitch.
But if the outflows begin, bond funds will become forced sellers. They may still have the view that a hard landing is coming, but they'll have to sell. So I think watching those weekly bond fund inflows, I think they were important all along. They've become a lot more important now.
Do we need to get used to big moves then in treasuries? Do we need to stop overreacting to 5-10 basis points on any given day? Is that potentially the new normal?
The swaptions market is saying that the new normal now is 8-9 basis points. I think that's fair. We're in an extremely complicated environment. The data is not very clear. The Fed also, I think importantly, is telling us that we're not in any rush to cut rates. So in this data-dependent world, I think volatility, uncertainty is going to be high. That's why I think liquidity is actually important, and investors should pay attention to making sure you've got liquid assets in your portfolio. So in a 10 basis point move, you don't have to actually sell assets. You've got those liquid cash.
Priya, this was fantastic. If you are just joining us, it is Payrolls Friday. Equities on the S&P 500 positive here by 0.2%. Yields a little bit higher by a couple of basis points, 474.22. TK, a lot to think about there with Priya Misra.
A lot to think about. Forget about the math, because she nailed it with the emotion. And this goes to what Chris Whalen, who's expert on banking, said the other day. There becomes a silence. And the silence in the Misra analysis is where long-only buy-side asset managers come in, and there are liquidations from retail and institutional. And that silence is in an office when you look at your Bloomberg or you look at your blotter and go,
oops.
Oops. And Priya nailed the process that we've seen before.
Just to be clear, Priya, not the base case for you, I assume.
Absolutely not. I would argue that there's value in bonds here. You're supposed to hedge the risk asset in your portfolio.
You sound like Bob Michael. That's good.
I do work for him.
Okay.
Priya, it's good to see you. Priya Misra of JP Morgan Asset Management. Priya, thank you. Coming up in the next hour, Nadia Lovell of UBS on this equity market, as we are poised for a 5th consecutive weeks of losses on the S&P 500. That can all change this morning with one data point a little bit later at 8:30 Eastern Time. The payrolls report just around the corner. 170,000 is the estimate. To weigh in on some of the politics of all of this, the strikes, not just in the auto sector but in healthcare as well, we can catch up with James Lucia of Capital Alpha Partners. All of that still to come from New York City this morning. Good morning.
The border wall, the money was appropriated for the border wall. I tried to get them to reappropriate, to redirect that money. They didn't. They wouldn't. And in the meantime, there's nothing under the law other than they have to use the money for what it was appropriated. I can't stop that.
Do you believe the border wall works?
No.
What a crazy exchange with the President of the United States. TK, they're going to start building the wall because they have to, but they don't believe it works. What do you make of the exchange in this country in the last 24 hours on the southern border?
Within the time constraint of morning TV, I'm not going to sit back and do old fart stories, but the bottom line is I have a crystal memory of the day Ted Kennedy of Massachusetts and Carlos Gutierrez of the Bush administration went down in flames. Why? They don't have the votes. And from Pritzker's, Illinois, to what you're seeing with the president in the Oval Office, the Democratic Party realizes they don't have the votes. Much better on the Sunday talk shows. Margaret Brennan will kill it on Face the Nation, etc. They don't have the votes. Simple as that.
Much more on this a little bit later. Let's turn to the price action on this payrolls Friday. 170,000 is the estimate. The price action going into it looks like this. A little bit softer on the week, firmer on the session, up by about 0.25% on the S&P 500. Yields higher by a couple of basis points, Tom, 474. Crude's had a terrible week, down to 82 on WTI, potentially the worst week going back to March.
We're going to advance this, of course, with what we see with this potential merger in the Permian Basin. We'll get to that through the morning, and somehow I don't think the story of a $60 billion transaction will go away. Joining us now, and this is beyond timely, James Lucier joins us, senior political analyst at Capital Alpha Partners, a veteran of the Washington Wars. James, this is going to be a 2-hour conversation. Bramwell said I got to back it up to an hour-and-a-half conversation. There's so much going on. Let me just begin. I know John wants to talk Jobs Day and the strikes. How do we get to November 17th this leaderless?
Well, the point is there's nothing to look for but a shutdown on November 17th, I think. There are two candidates for Speaker in the House right now. Neither one is close to locking up the votes. It's a good chance that neither one will lock up the votes. And the Speaker race is going to take a very long time to sort out. And while they're sorting the race out, the House is basically going to be paralyzed on everything having to do with appropriations or continuing resolution or Ukraine or any of those topics.
If they're paralyzed, what is the impact on the President of the United States?
Well, the President of the United States is just fine. You saw him there. He is in full command of his executive powers. He can do as he likes. The issue is not really that the House isn't meeting. The issue is that without a functional speaker, you can't bring legislation to the floor. And without someone who is an elected leader of the Republicans, they really can't broker the deals they need to make on appropriations bills or continuing resolutions or, again, Ukraine. So the U.S. government is working just fine. It's just that anything that requires a decision from the House of Representatives is not going to happen, not by next week, probably not in 2 or 3 weeks.
James, what do you make of this whole border wall issue? The fact that President Biden came out yesterday and basically said, my hands are tied. I have to finance this thing that I said that no more money would go to this. Is this basically a way of him having his cake and eating it too, coming to some compromise and looking like he's doing something about the border without having accountability?
Well, it's a tricky issue because there's not going to be any funding for Ukraine unless there's some movement on the border. I think that if you parse what the House Republicans are saying, they're not categorically opposed to Ukraine in all circumstances, but they want to see border funding at the same time. Meanwhile, if you look at the polls, Republicans are currently at a 40-year advantage over Democrats in issues such as immigration, the economy, and crime. It's really ironic that Republicans have such a commanding lead in the polls on the top issues that voters care about, and yet they're completely feckless in the House. They're wasting this opportunity. I think this in part is a defensive move by the president to deal with the issue as best he can.
Based on what you have heard, there's a lot of disagreement within the Democratic Party about how to go about reforming immigration policy, which may be why President Biden is trying to lean into one idea and say that it's out of his hands. Are you hearing the Democrats coalesce around anything concrete with respect to immigration policy and having a serious conversation about it?
I think they are. I think that the first thing, the most important and hopeful thing, is that at this point, both Democrats and Republicans recognize that there is a problem here and that there is something that needs to be done. Now, would Democrats go for a border wall? Maybe not. Would Democrats want punitive treatment? Maybe not. But everyone agrees that there needs to be some mutually agreeable package here.
Okay, well, what is it? You've got decades of experience of people agreeing to disagree. I'm fascinated, James, with great respect for your work at Prudential for years. Where's the compromise on immigration? I, frankly, with respect, don't see it out there.
I'm not sure I see it either. I think that simply putting some numbers on the table, more dollars for border enforcement would probably go a long way. Restoring something like the Remain in Mexico policy might go a long way. Modifying okay,
but James, I don't mean to interrupt, but we spoke with the governor of Connecticut, who's a little bit removed from this, Lamont of J.P. Morgan, and of course, all of his, focus in Connecticut. It's a unique story, to say the least. Governor Lamont told us, stop them at the border. Isn't that the national attitude?
That is the national attitude, absolutely.
I'm fascinated how we legislate stop them at the border. Have you heard a theory?
Well, again, more money, border technology. I think the problem with the wall, more than anything else, is that President Trump made it so iconic, so totemic, that it's untouchable for Democrats. But, everyone agrees that the situation in cities like New York, Boston, cities across the country is becoming untenable because it's not just the frontline border states, Texas and Arizona, that are dealing with this flow. It is now downtown New York.
James, when you talk about how the Republicans have been unable to really capitalize on this, where do you see some of the discussions going in the House and the certainty of a government shutdown come November 17th?
Well, I think the shutdown is fairly certain because there's been no progress whatever on moving appropriations in the House or the Senate at this point. The real question is how the House could possibly pass a continuing resolution on November 17th. I do think that something will get done eventually, because what's going to happen is that the Senate will pass something, send it to the House, and that bill from the Senate will eventually be moved by means of what's called a discharge petition. So I doubt any shutdown is going to be more than a couple of days, and there is a mechanism for resolving it quickly. But if you see a potential speaker like Jim Jordan, a Jim Jordan speakership is not going to be one that is congenial to getting a CR done. So, I think we've got to count on a shutdown, assume it lasts a few days until the discharge petition kicks in, but the next one is going to be longer and harder.
So, James, just to put a bow on it, just to jump in, you get Jim Jordan, base case shutdown? Yeah.
Yes. Well, actually, my base case is shut down no matter who wins right now. I think that while Scalise and Jordan are the leading candidates, neither one is certain. There could be a third person, but I just don't see how anyone will be ready to handle a CR by November 17th. I hope it's a short shutdown. But what worries me is the prospect of multiple shutdowns after this and a major showdown on a large appropriations bill or series of appropriations bills at the end of the year.
I think we all hope we don't have to talk about it anymore, but I think we expect we will. James, thank you. James Lucier there of Capital Alpha Partners. TK base case shutdown. He's not alone. I don't think it's contrarian. Then that's rather consensus going into November 17th, isn't it?
Let us remind ourselves, and I have the image of walking into Ames, Iowa, into real wrestling years ago, John, which I can't even explain to you the impulse of that. Jordan is a legit Division I stud in wrestling. The football equivalent is like he won the Rose Bowl and scored 3 touchdowns.
Are they skills he's going to need?
Those are skills. Lucier, I've known Jim Lucier for years. He is the most deadpan analyst in Washington. And the backstory here is we're going to have a wrestling star. I mean, this guy's heavyweight with an economics degree, sure. I might point out. But Jim Jordan, in his shirt sleeves, wrestling the House is going to be absolute original history.
I think his demeanor, Lisa, captured the moment, didn't it? It's how most people feel about this story.
It's just basically resignation and basically, they're kind of ironic amusement as you watch.
A lot of voltage there.
1 hour away from the payrolls report. Ellen Zentner and Morgan Stanley coming up. 60 minutes away from the payrolls report in the United States of America. 170,000 is the estimate in our survey. Your equity market going into it slightly positive on the session, down on the week, up by 0.2% on the S&P 500, up by 0.22% on the Nasdaq 100. In the bond market, phenomenal moves over the last couple of months. 474.22 on a 10-year, up by 2 basis points today, heading towards 5 consecutive weeks of yields climbing, Tom, on a 10-year maturity.
I think we need to frame this right now. It's so important, is that problem in bonds sustains this morning. It's ever so slight, but I got yields set higher this morning. I got 210 spread like a rock at negative 30 basis points. And as Priya Misra talked about, I got a 10-year real yield higher this morning, 2.43%. So there's that tension into the report.
Speaking of tension, we had a 30-year nominal yield through 5% earlier this week, 490.67 at the moment, up by a couple of basis points. The fate of this bond market, today at least, potentially in the hands of the jobs report, which is just 60 minutes away. In foreign exchange talk, tons about this. The euro against the dollar, 105.54. Slightly positive today, slightly negative on the week. Lisa, this would be 12 weeks of euro weakness against dollar strength if we closed here.
Who's going to go long euro right now? What is going to be the motivating factor to go long euro at a time where U.S. data has been outperforming and you have oil prices that are seriously in question? This is the challenge at a time. And I do wonder, based on the volatility and lack of conviction, a job surprise to the upside, what does that do to the euro?
Yeah, not good things, you'd imagine, based on the price action we've seen so far off the back of high yield, stronger dollar. The other way, maybe Lagarde sitting there wanted it to go the other way. I don't know. I'm just saying.
You think she's trying to game the jobs market?
Just throwing that out there. Perhaps you could imagine.
Come on, please.
Under surveillance this morning, the US jobs report due out in about 60 minutes' time. The median estimate in our survey calling for a print of 170,000, with the range of calls from Wall Street's biggest banks. Citi at the high end, 240, Wells Fargo at the low end, 150. We'll catch up with Ellen Zentner of Morgan Stanley in a moment. 180. That 240 over at Citi. Andrew Hoddenhorst, TK, still looking for another hike from this Federal Reserve.
Well, it shows the disparity, and what we're doing here at Surveillance is we're talking to the different opinions, and to go from Wells Fargo to Citigroup here shows that the efficacy of 1 over the square root of n, the standard error of this report, is ginormous. It's embarrassing how everybody has to be certain, but they're really not certain.
Let's talk about a deal, the potential for one. Yes. Exxon nearing a takeover of Pioneer in what would be the company's biggest acquisition since merging with Mobil back in 1999. The deal could be worth as much as $60 billion and maybe finalized in the coming days, according to the Wall Street Journal. This morning, Lisa, Pioneer up by 11%, Exxon down by about 2.4%.
So synergies here in the shale patch, I believe it values the shale patch at, $60 billion or something of that nature. At this point, I do wonder whether policymakers in the U.S. are going to sign off on this very happily to say, if we can have something that's as efficient to be competitive with the Saudi Arabian OPEC Plus complex, well, kudos to us, because go back to the energy independence, that might be what people are looking for after what we've seen over the past couple of years.
Do you get a seat in Vienna if you're producing 1.2 million barrels a day? If you're a country, you probably do.
If you're a country, you do. I don't know. I doubt it. I highly doubt that they want to really include this particular part of their club.
Amazing to see, Tom. Just an absolute monster.
Yeah, we're so time compressed with the news flow this morning. John, let's do it real quickly. Scott Gruber's at Citigroup. He was at Sanford Bernstein with Ben Dell and their fabulous hydrocarbon team, and he and his team put out a blistering note this morning of how the pros look at this transaction. They do not look at what the media is looking at. They say to themselves, if you take out a set of synergies, what are they buying on West Texas Intermediate equivalent when they buy Pioneer? And the answer is they're buying a blended average, this is my approximation, of $69.25 West Texas Intermediate, and then Citigroup sets that up to their $78 bogey, and they say that's the arbitrage where Exxon comes in and they get a gross up off the post-synergy value. WTI. That's how the adults look at it.
Right now, Tom, 82, Brent crude, 84. Let's finish on this story. Tesla cutting the price of its Model 3 and Model Y cars in the US after its third quarter deliveries missed estimates. The Model 3 and Model Y cars account for the bulk of Tesla's sales in this country. The stock a bit softer here by 1.4%. Lisa, I've now lost count.
Exactly.
How many times this has cut both ways this year so far?
But this comes on the heels of a disappointment when it comes to deliveries. And that, to me, is really telling. It is also telling when you have BYD, basically, of China, eating their lunch. I mean, they are selling cars at a much lower cost point, and they have the backing of the Chinese government. And so what's Tesla's game plan at this point? What is their edge?
What is the brand destruction of the uncountable price cuts? I just don't get it. How do you feel if you bought a Tesla, whatever, X months ago?
To be honest with you, I'm not thinking about Tesla or the Chinese manufacturers. I'm thinking about everybody else. This is a war between some people who can have that war.
Yeah.
Tesla, the Chinese manufacturers, everybody else.
Yeah.
This makes it very painful for Detroit's Big Three to get what they're trying to do off the ground, Tom, up and running to compete with Tesla and the Chinese manufacturers.
We begin our jobs coverage. We do so with Ellen Zentner, chief U.S. economist here. We go into the next hour and then beyond. I want to go to your wheelhouse, which is your reading for the years you've been doing this of the American consumer. Into this jobs report with a summation of Morgan Stanley research, including an analysis of small business. How flat on their back is the American consumer?
So I still think that the lower income consumer is struggling. I do think with their real wage growth turning positive as inflation comes down, it's been getting better. But job growth is slowing, so overall labor income is slowing, and that predominantly drives spending. Credit quality is still good. And you can see that delinquencies are rising among subprime consumers, lower credit quality segments. And you could breathe a sigh of relief and say, yeah, but it's only just risen back to pre-pandemic levels, except the pace at which that deterioration is occurring is worrisome. We don't think the bottom is falling out of the consumer, but I think already we've seen early signs of credit card data that have really fallen off in September. And whether that's the Taylor Swift effect fading, the Barbenheimer effect fading, it's going to be seen in the numbers. And it's going to look like a tremendous loss of momentum.
The bottom fell out of the Treasury market. Can you give us an idea of what the conversations with Matt Hornbeck sounded like this week when you two were talking about what's been going on and what it means for Fed policy?
So I think there's the strategist side of it, right, which is flows. You've lost a lot of big buyers that just aren't there, including the Fed. And that's driving yields higher. From an economist's perspective, it's why does the market suddenly believe the Fed? Why do they suddenly give 110% probability that the Fed is going to be right in its forecast and deliver exactly the kind of policy restriction for this long? Tom mentioned 2.5% real yield. That's only going to get higher the longer they remain on hold. And the thought that the economy could withstand even higher real rates from here for a quite extended period of time, I just think is a pipe dream. And if I were the market, I wouldn't say, yes, you are right. You've given me the stop plot. You've told me this is what you're going to do. Why? Why are they suddenly putting all their eggs in one basket?
Well, you mentioned two things there. The big buyers stepping away and this general acceptance of what the Fed is saying. So are you saying that it's more heavily weighted to accepting the Fed's forecast and not the latter? In other words, that this is truly just a misperception in markets versus a structural change that could keep rates higher, even if, the Fed does shift gears in any way?
Yeah, so I do think that structurally real rates can stay higher for a time because we still need to be restrictive, right, in order to ensure that inflation continues to fall toward goal. You're asking the $1 million question, right? How can you extricate the two and say, okay, this is the basis point owed to flows, and this is the basis point owed to just a difference of opinion and outlook, right? You do have to have some risk built in that the Fed is right and you're wrong. Right? It just seems to be an extreme. And if I'm a policymaker, I'm looking at these moves and saying, you're doing a lot of the work for me. And so maybe I don't need to be as restrictive. There's still a lot of effects to come through to the economy from this.
From an economist's point of view, does this increase the chance of a hard landing from your perspective?
Well, I think when in the volatility that we've seen, and in particular how quickly financial conditions have tightened, if that's sustained, then absolutely chances of a hard landing go up. I mean, I know on prior shows I've come in and talked about our recession probability. We've had a soft landing call for so long. My probability of recession is well higher than my peers who only just embraced the soft landing. And why is that? Because when you think 12 months out from here, we're not out of danger. I still have a 40% probability of a recession occurring within the next 12 months, even as I've had a strong call on the economy. We are seeing things slowing, and the ugliness under the hood can come out pretty quickly.
Well, I'm going to go right there. You've got Eric Stein at Morgan Stanley. He's something. He was for years at Eaton Vance up in Boston. He's got some serious academic cred out of the University of Vivaldi up at Boston University. What are you learning from your bond people like Eric Stein that you're folding into your economics?
So that we don't think real rates are going to remain this high for this long.
How many basis points on a 10-year yield? How many basis points will they come in? You're looking at 10 beeps, 20 beeps, or a substantial
Oh,
move?
no. Well, Matt Hornbach, Lisa mentioned that I work really closely with, right? They're oversold. It's oversold here, right? And so I would imagine more than 30 basis points.
Bottle that.
Bottle that.
You heard it here. 30 basis
on the bond market.
Zentner to the rescue.
Hornbach. Vishy.
Zentner to the rescue.
Okay.
Come and save the day.
And then I think you're going to stick with us, hopefully. And Zentner of Morgan Stanley. Just to get you up to speed on some of the price action elsewhere, the equity market on the S&P 500 here, positive by about 0.1% on the S&P. In the bond market, shaping up as follows. Yields a little bit higher today, a whole lot higher over the last couple of months. Your 10-year looks like this. Yields up by 3 basis points, 4.7464 in foreign exchange. Lisa, this is the one for you, I think. 105.55. The ECB watching this one closely at 8:30 Eastern Time.
I just think that it really highlights how this has been driven by U.S. strength in addition to European weakness. Honestly, the story really is in the bond market, though. Really, if we do get an upside surprise, how much more of a, I don't want to say disorderly because I think that will trigger some people, but I think that there's sort of a violent move in yields.
A Wall Street type sensitive. They get triggered.
All
by
the
words,
time.
like disorderly.
Like disorderly, hives. But there is a question of, whether we end up getting a similar type of jump condition upward that really does follow on the heels of this report.
I go back to that note from Michael Hartner this morning of Bank of America. Question, what is no one asking you about? Answer, 2024. Just seems to be this focus, the obsession with like the next month.
X-axis
the next
is
4 weeks.
Yep. Absolutely. I just did, because Zentner ordered me to, a 2 standard deviation study of the Zentner call of coming in 30 beeps on 10-year at real yield. It gets you nice through the 50% tendency and right sitting on the long-term average. That's how fast we've come up, that even if we get the Zentner move lower in real rates, we're still sitting nicely on the long-term trend.
If you are just joining us, welcome to the program. Your equity market just a touch firmer here, up by 0.1%. If you want an outlook from elsewhere, this from Citi, Andrew Hollenhorst, saying this: despite the rapid rise in Treasury yields, Fed officials are likely to maintain their higher for longer rhetoric and proceed with a 25 basis point rate hike in November. And let's build on that a little bit. Do you think it changes much, this move we've seen in the bond market in the last month?
No, I think the bond market's focused on the higher for longer theme, and whether the Fed hikes another 25 basis points. The market has already half of that expectation priced in. I don't think that changes much. I have a very strong view in the other direction. I think they are done here. We've been calling for them being done here for a time, and I think you build on that the longer that financial conditions remain this tight. Right. Again, going back to the market doing some of the Fed's job for it. I'm still chewing on what Mary Daly said yesterday. I mean, she gave us a mouthful. And that is the way policymakers are going to be shifting, right? Financial conditions have tightened. They've tightened in a way that leads to uncertainty. Uncertainty means the prudent step right now is to just remain on hold.
You think she represents the consensus view on the committee?
Well, I don't think that she presents herself as I am the consensus on the committee, but other policymakers are already moving in that direction.
So your disinflationary vector's in place, and it will give the Fed ability to move when? Not November, out a couple meetings.
No, I don't think that I think the next move is a cut. I think that they're on hold from their July meeting when they delivered the last hike until March of next year. And that is well earlier for the start of cuts than the market, but that's an 8-month hold while real rates continue to rise during that time and inflation is still coming down. Again, difference of opinion in forecasts.
Ellen, wonderful to do this every Payrolls Friday with you, as always. Ellen Zentner there of Morgan Stanley. Coming up at 8:30, the US jobs report and former Fed Governor, Randy Kroszner, he's going to join us, as he always does. In a moment, Anna Wong of Bloomberg Economics, giving us the view of Bloomberg on what to look for from the Payrolls report in about 45 minutes' time.
Already repriced, not just to the pre-COVID levels, but to the pre-GFC levels. So regime shift has really already happened. In our view, it's actually an overshoot. but it's already happened. I mean, we're at the Fed's target. We're not in the 1970s and the 1980s here in terms of the economic growth environment or the inflation environment. The Fed is telling you, we're not going to stop until it's painfully obvious that the economy can't handle it.
Kelsey Barrow, JP Morgan Asset Management, together with Bob Michael's team, Priya Misra, who we called up with a little bit earlier, looking for a hard landing in the United States of America, particularly with the additional sell-off we've seen in the bond market. And what a sell-off it's been. Treasuries now priced as follows, going into payrolls, that data point about 45 minutes away. Your jobs market, 170,000 is the estimate. Data, your bond market, looks like this. Your 10-year yield up by a couple of basis points to about 474.43. Your equity market, TK, positive by about 0.1%.
We just saw something there with Ellen Zentner, who I adore, which is the partition of silos on Wall Street. And the economists really don't want to talk about what bond markets are doing. And the bond market people, of course, don't want to second guess their economists and all. We don't have that luxury at 8:31. We're going to have to conflate market reaction to this report. We're going to have to conflate in real time the theme, the what if, the probability that we extend, as Jens Nordvik says, this bond carnage. And they're in their silos, they're really not anticipating that conflation.
Alan Ruskin, Deutsche Bank, a weaker number will be believed. Put out a note yesterday, actually pretty interesting. A weaker number will be believed since it would be consistent with the 3-month NFP average that has been on a steady slowing trend consistent with the sub 100K payrolls by the end of the year. So yes, these numbers can dance around, Tom, but the trend,
the vector, absolutely,
is for a little bit of a slowdown.
And the 3-month annualized, and we talk about it with disinflation and inflation statistics, but you can do the same thing with the jobs report, as Dr. Ruskin does there. I'd go to David Kelly at JP Morgan, who was the first one I really heard within the universe say, what's the vector to a negative non-farm payrolls report? It's out there somewhere.
Well, that would be a shocker, wouldn't it? I can tell you that's not even the low end of expectations today. The low is 90.
No, that would be, no.
Do you know who's the high? Ian Shepardson, Pantheon Macroeconomics, 250.
Oh, but it's because he likes Newcastle.
And he thinks they are
so
statistical quirks. He's still looking for a slowdown. So don't take that as a bullish number from him. He thinks that's flattered by state and local education numbers, something like that.
I mean, I don't do the guess the non-farm payroll thing, but today I'd be baffled. I feel sorry for people that actually have to
blindfold top. Throw a dart. You know how this works.
Yeah, it's the way it works.
Yeah.
And along with this, that's what she does. She has a blindfold and throws it at the dartboard. Out of Chicago, and of course with Bloomberg Economics, and we know her for one of the great calls of modern market economic history. Guess what? Rates are going up. Anna, did you ever think we would get yield up, price down, as we've seen in the last 90 days?
Well, I did warn after the Fitch rating downgrade of U.S. sovereign that the bond vigilantes might come out, given that looking at that the fiscal deficit is going to hit 6% of the GDP at the end of this year. And if the economy does fall into a mild recession, as we predict, it could easily, fiscal deficit could get to 10% of GDP very quickly due to automatic stabilizers. So, yeah, I think the U.S. Fiscal trajectory is not looking good, and it's just a matter of time people should recognize.
And I love having you on. 3 people just drove off the Garden State Parkway in New Jersey. Anna Wong, if we get any sense, let's take a midpoint. Forget about 10%. If we go from 6% out to 8%, what does that do to the IS curve? What does it do to the real economy of America?
Well, if rates go to 8%, then there would be first a level adjustment. It is the jump from where we are right now to 8%, where the adjustment will happen. But after the economy get used to 8% interest rate, there'd be like, the now baby boomers who survived the 1980s and say, well, my mortgage rate was 12% back then. It's okay.
Lisa, I guarantee you, Dr. Wong is never going to get a job at a White House. Doesn't matter who's in charge. Wong is never going to work at CEA.
Well, Anna, on the way to 8% mortgage rates, there is a question of the labor market, which how is it going to hold up through all of this time? Why are war notices important?
Because war notices tell you where the layoffs are coming from and where it will start to show up in the jobless claims. So a big mystery right now is how low the jobless claims is, right? But war notice actually could lead the jobless claims by 60 days to 90 days, 2 to 3 months, because after people are laid off, they still get severance, and so right now what we are seeing is that the notices, WARN notices in Sun Belt and in Rust Belt have been rising, even as California's AI boom is causing improvement in unemployment. So I think what we're going to see in the next couple of months is more troubles in places like Arizona, Texas, Colorado, Idaho, places that had benefited from the pandemic, migration.
Why is this going to lead to a higher unemployment rate versus just simply the churn that we've seen in the economy moving over to the labor market?
That's a really good point, because I think there is some truth in the idea of rolling regression. We're seeing California, layoffs coming down as Sunbelt layoffs go up. But I think ultimately the unemployment rate in California is not going to fall fast enough to offset the unemployment rate increase in other places.
So right now, as you look for this particular report, do you agree with Ian Shepherdson that we could get a upside surprise that's just simply distorted by everything and all the technicals? Or are you looking for something to really highlight that weakness that you see in these WARN reports and in some of the shifts that you're seeing in the Sun Belt, in Idaho?
Yeah, absolutely. I'm with Ian Shepherdson on this one. I think the risk is tilted to the upside for this report. We still have a lot of catch-up hiring in healthcare sectors, but there's just so many shocks in the next couple of months that I could see a negative payroll report by the end of the year.
Anna, you've been brilliant on the y-axis. I want to take you to the x-axis right now. If we don't get the Anna Wong movements, the what-ifs, maybe the probability of higher rates, what if we just stay here with a 10-year real rate of 2.4%, that, 5-ish or under 10-year yield as well? What are the ramifications for the jobs market and American GDP?
I think if we stay here, if we don't move lower, then what you're going to see is the consumer's delinquency rate is going to rise, because the denominator, which is income growth, would be softening, but the numerator, which is interest rate compounding their debt, would be growing way faster. And so what you will see is that consumer will have problems, and then firms' profit will fall. You will have that short and mild recession.
Anna Wong, I just got a note from Andrew Hollenhorst, the city, an update from him, actually responding to Lisa's interview conversation with the San Francisco Fed President, Mary Daly. He said yesterday, President Daly suggested that the rise in 10-year yields might be a substitute for a 25 basis point hike. He says, we think the centre of the committee will remain data dependent in determining whether to raise rates on November 1st. He's looking for a hike. Anna, what would you say back to that?
I think there's a substantial risk of a hike in November. And I think the bigger report is actually next week's CPI. We think there's an upside risk for a core CPI to be 0.4 due to higher seasonally adjusted used car prices. So, definitely it's on the table.
Looking for a hike, potentially, in November. Anna, thank you. Anna Wong there of Bloomberg Economics. There you go, Lisa. Start a conversation on the south side here. That conversation you had with Mary Daly yesterday. Looking for a 25 basis point hike still over a city. He does not think it represents the centre of this committee.
Although we heard from Ellen Zentner that she thinks it does. So there's a sort of a split idea based on where people shake out in terms of the economic data. I think ultimately it will come down to whether the data does continue in some sort of more accelerated pace. But if that's the case, and if you get some sort of significant increase in longer term yields, does that change the scenario even more with respect to financial tightening?
What we have been through since 2007, the third week of August 2007, is Ellen Zentner said in her note, the uncertainty of this report and its effect on the markets. Can I say we've never seen this? I have a 10 standard deviation move in the inflation-adjusted real yield. Like I said earlier in the week, it was never Tuesday, never ever Tuesday. Hey, guess what? Fridays, we're still going to Never Never Land right now on Friday.
What's the Tang like this morning?
The what?
The Tang.
The Tang is good. Tang Zero helps out. I've had problems with my feet. And the doctor told me...
Had a little bit of an accident.
Yeah, we had a little bit of an accident.
Yeah,
I was reaching for the Tang and I spilled
mopping it
over
up
here.
for you.
Ferro helped mop it up. The interns helped as well. Sure. And I've had to cut back on the Tang, actually.
That was a full cup, whatever that was.
It was.
It's all on the floor now.
It was.
I cleaned your phone for you. I think I've rescued it.
Is it okay?
Don't worry. I think it's just about okay.
It's a reason to get the new iPhone, right?
Nadia Lovell of UBS Global Wealth Management coming up. Your payrolls report 34 minutes away. The estimate 170,000. Equities higher by just 0.1%.
The ability for markets to move very quickly is very high.
The economy is still in a good place, not a great place.
I think that there are some places that are going to continue to be vulnerable.
I think we're getting closer to a point where the Fed will have to acknowledge that there's something more significant going on.
They're fighting inflation that I think is already clearly coming down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Yes, it's Jobs Day, but it's a different Jobs Day here on Bloomberg Radio and Bloomberg Television. Lots to talk about. John, I'm going to talk about the seismic shift from the last Jobs Day. Take the old benchmark before your time, 30-year U.S. bond, like 4.30%, and it's 4.90% this morning.
Well, back on the first day of last month, Tom, it was 4.18 on a U.S. 10-year. Right now, 475, pushing 490 earlier on this week. New cycle highs over the last week.
We're going to conflate what's going on in the markets into this report in 29 minutes. I can honestly say I think it's the first time I've ever done that in all these years, and that's the level of carnage that's still out there.
So let's go through the numbers. 170,000 is the median estimate in our survey. There's a pretty wide range. At the low end, 90. At the high end, 250. 240 is the view from Citi. I keep going back to Andrew Honhorst, Tom, who, despite these moves in this bond market, still believes this Fed can go again in November.
Yeah, well, the debate's out there as well, and the debate's also with the Fed, and the lead on that is Lisa Abramowicz's wonderful, delicate conversation with Mary Daly of San Francisco yesterday. I figured, you'd have some rubber chicken, get through lunch, have a good time. And you made some real headlines. What was the distinctive message from Mary Daly within Jen Nordsvig's bond carnage?
Well, you heard this from Ellen Zentner, that there is a financial conditions tightening that is going to offset what the Fed might have to do. That basically what we've seen in the bond market might supersede the need to hike rates again. The question is, how sustainable is this? How much does this crimp economic activity if we still see incredible strength that is surprising to the upside the way that Andrew Hollenhorst thinks? Well, then people might think, well, even if we do see that kind of tightening, it's sustainable, and we're looking at an economy with some other intense drivers that have legs.
And John, off this Jobs Day and wage growth, which is sort of the price dynamic of the Jobs Day, the question is, are we super restrictive? Are we fighting the last war?
We're going to find out, aren't we, based on the next couple of reports. Problem for the Federal Reserve, and I think the problem really for bond market investors right now, Tom, trying to work out what this data means for treasuries after the move we've already seen. Well, it's been a massive move already over the last 5 weeks.
Brilliant. We didn't talk about this in the conversations, Kelsey Barrow that we had yesterday, Peter Cheer, Priya Misra this morning, and Priya talked about the migration. Lisa, this is your world, migrating out from full faith and credit treasuries, and the bad things that happen there end up migrating out into credit and then into distress.
Well, this is the key issue, right? We don't understand what it means for a company that grew up in zero rate eras to suddenly have to refinance at a 9% era for a high-yield company, at a 10% rate. And at what point does this become a fundamental concern that threatens the viability of some of these companies?
That's not a zero coupon bond, John. That's a zombie coupon
It's
bond.
the knives and forks on the plates that I don't like at the Economic Club in New York. As the conversation's going, why can't they eat before the talk? Why do they have to eat during the talk?
Full disclosure, folks, and I
sometimes... It makes it so hard to listen to. It's usually you with the knives and forks on the plates.
No, the tradition on the podium is we don't eat until after the speaking and the Q&A. And I go in there starving because I've been up since 3 a.m. and I want to hit the rubber chicken like nobody on this stage.
Like nobody's business.
Get out of my way.
There. Well...
are we here? Let's do a data check.
I thought Lisa was going to say something.
I thought she was
Okay, well, I'll just say this, that actually they put the salad out first, and then they serve the meal afterwards. So they actually are trying to cater to some of those concerns.
The salad.
Yes.
That's, okay. Equities on the S&P. We'll get back on track. positive by 0.1% on the S&P 500. Yields here, TK, up a couple of basis points, 473.81. The jobs report, 25 minutes away.
Well, that's where the yield is right now. I'm going to look at the VIX, 18.63, and the equity market really okay, what's happened? Not much. Boy, do you not see that away from equities. Briefing us is always, we start strong in this Jobs Day hour with Nadia Lovell, Senior U.S. Equity Strategist, UBS Global Wealth Management. Nadia, I talk about the VIX at an 1819 level. How are equities ignoring the bond carnage?
I don't think equities are ignoring it. I mean, you're seeing valuation adjust to all of that. You've seen the market pull back from its high, down 8 or 9% from the late July high. And so, but we do think that this pullback is healthy. Also, I think what's happening in the market is that we sort of been in this micro news air pocket, if you will, ahead of the earnings season. And so the earnings season should be able to provide some clarity on the outlook for corporate earnings. We do think that corporate earnings will start to inflect back up in the third quarter, and we should be able to see growth. So that could be actually a potential catalyst for the market.
Are we in a bull market, or with this difficulty, this emotion of the last month, have we reaffirmed some form of bear market trend?
We think that we're still in this bull market trend. I mean, the earnings, again, should start to re-accelerate. And reality is, it's normal to have a pullback. We're not even at, a 10% correction yet. And so I think that we've gotten used to, at least this year, driven by the rally in tech of the market being on this steep upward trend. But a pullback is healthy. It does take a little bit of a valuation fraud out of some areas of the market. And so in our view, the risk reward is actually looking a little bit better for the equity markets from here.
So are you buying?
We are. We will be legging into this, weakness, continuing to dip our toes into it, but be selective in the areas of the market. You sort of want to maintain that balance. And so we have a balance with some defensive exposure along with some cyclical exposure, as well as some exposures to some of the secular trends that are happening in the market.
Are tech stocks defensive or growth?
I would say I would put them in the middle, in terms of yes, there are parts of tech that are quite defensive in terms of the software areas of tech where there's a high level of recurring revenue. So that's by some stability in the earnings. And of course, you have other parts of tech that are more cyclical in nature, whether it be semis or hardware. But we are also seeing some bottoming in trends there. So tech kind of, plays all different areas. But I think overall, how I would categorize the tech sector is high quality.
Well, the high quality there translates to free cash flow. And to me, at the end of the day, and with all the uncertainty described by the bond market, Ellen Zentner of another house, Morgan Stanley, says there's great uncertainty here in 23 minutes. Okay, Nadia, all that's great. But the only thing I can hang my hat on is free cash flow. Do you agree with that? That we're really back to Graham, Dodd, and Cottle analysis?
I think it's important to look at free cash flow in this sort of environment, and also, strong balance sheet as well as part of that equation, especially when you're in an environment where rates are likely to remain higher for longer. You also want to make sure that those companies are able to self-fund themselves and not have to dip into capital markets.
Nadia, can you give me a target here on SPX, or are you going to wait for a Monday announcement on that?
No, for next year, we're looking at 4,700. So we do see upside to the market from here. Of course, we'll see what the job reports are at 8:30. But reality is, I wish that we would get out of this sort of twilight zone where good news actually becomes good news again and bad news is bad news. The fact is that the economy does remain strong. The consumer remains strong. And so hopefully at some point the market will start to appreciate that. And I think that the earnings season could be that catalyst to do that.
Let's finish there.
Yeah.
There is this question about how you trade around the jobs market. Some people don't want to. Some people say they don't, but do anyway. How would you, all things being equal, trade a good number? Is good news for you yet?
I think good news is good news at this point. In our view, we think that the Fed is done hiking. As you've been talking about all morning, financial conditions have tightened significantly. At least in your interview with Daly yesterday, obviously, the fact that we've had this move in the bond yields does account for sort of additional rate hikes. So we're in that Bostic camp where we think that monetary policy is significantly restrictive. And so we would look to be positive and good news being good news commodities at this point.
Where do commodities fit into this? We were talking about the deal in the shale patch, Exxon coming out with the biggest deal that they've done in decades. How much do you lean in, even after how much of a bid up we've seen on the heels of some of the weakness that we've seen over the past couple of days?
Yeah, I mean, we are still constructive on the energy sector, and we actually think that this pullback in oil and energy does give investors who might have missed it an opportunity to really dip into this well again. I mean, OPEC Plus remains quite committed in constraining supply, and we know that demand picture remains very strong. So we continue to believe that oil prices, Brent, is going to be $95 and sustainable into next year. And, that free cash flow that you were talking about, Tom, it exists in the energy sector. Free cash flow leaders or 10% strong balance sheets and the likes.
Quickly here, Nadia, I love what you're saying. I want to say good news is good news with you. But I got a 5.49% 3-month T-bill. I mean, I'm sorry, the siren call of money market funds in a short paper is a huge constraint still, isn't it?
It is, but we don't think that these levels of bond yields are sustainable. We do think that bond yields will trend lower from here. I mean, yes, a 10-year bond yield could remain in this 4 to 4.5% range, but the economic momentum that we've seen early in this year, we just don't think that will continue into the fourth quarter and into next year. So we are looking for the 10-year bond yield to come down towards 4% by the end of the year and then trend towards 3.5% by the time we get to mid next year as the Fed looks to cut rates.
So given what you expect, is the biggest risk for you a re-acceleration in the economy or a hard landing?
A hard landing is the biggest miss. Equity markets isn't really priced for that. I think most people are in that soft landing camp. And we also know when you do hit a hard landing, that has implications for earnings growth. Earnings tend to pull back, in the mid-teens into that sort of scenario. And so we want to see the continued strength in the consumer. Inflation is coming down. We don't want a re-acceleration in inflation. So we sort of want that Goldilocks scenario to happen over the next 12 months. But time will tell and the data will determine.
It's what we always want, not too hot. Not too cold, just right, Nadia. Nadia Lovell, thank you, of UBS on this equity market. Appreciate it, as always. Counting you down to the payrolls report, fantastic lineup for you. Ronnie Krosner, former Fed governor, joining us going into the number. We'll get some reaction from him at the other side as well. Jeff Rosenberg at BlackRock will give us his perspective too. Mohammed Al-Arian, I can tell you, with us here in New York City in the studio. He's going to catch up with us at about 9 a.m. Eastern time to go into the opening bell and break all of this down. And then Secretary Sue, the Labour Secretary, or the nominated Labour Secretary.
I've lost track
TK.
of that as well.
Hasn't been confirmed just yet.
Yeah, what was that,
I know. Tom, we don't have a speaker either, officially.
Yeah, really.
Congress either, so,
Yeah, exactly.
Step at a time. If you're just tuning in, welcome to the programme. We are positive here by 0.1%. Counting you down to that payrolls report, let's call it 20 minutes away. Tom, the number we're looking for, 170K.
170K, and again, you go over the wage dynamic, which, John, you often do there, and to see if that's going to break. But, maybe the worst outcome here is stasis, where we just get another middling report. Nobody's talking about that. We're getting drama here, drama to the right, drama to the left, and what's the damage to the bond market if it's just...
Was it B. Mosey in Lincoln this week who said slightly negative? Was that him, Lisa? I think he said. Someone said this week, one of our guests this week said slightly negative.
It's the best case.
Would be the best outcome for everybody. Slightly negative, not too much on trends, slow down.
Yeah.
Just slows down the bond market, sell off a little bit. But it's good enough, it's decent, that you're not crying about a recession anytime soon.
For everybody to understand, Lisa can remember out about 1 week. I can remember out about 1 minute. Ferro's telling me things we did 4 months ago where he has a crystal clear memory of whatever it was. How do you do that?
I rewatch the programme all the time.
My deepest sympathies.
And I take notes from the guests. I've always done that. Go through the transcripts. Done that forever.
Okay, I'm watching
Which is why I remembered that Saudi America line that you used a long time ago.
How do you do that? I mean, I'm worried about F1 in Qatar this weekend, and on Tots Luton. Is it Luton? Is that how you pronounce it?
Is that what you're going to watch?
Tots Luton. We've
got Formula One back this weekend.
Formula One, I believe, is this weekend. Maybe next week.
I have to double check that. It's next week?
I don't know.
All right, we'll get up to
speed. I'm rooting for Orioles Diamondbacks.
Isn't it Vegas, really the Vegas race soon?
Yeah, Vegas race.
Okay, all right. Good to be up to date.
It's a sports report.
We'll do that in the break.
Where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Steve Major of HSBC, just one of the best in fixed income, had a tough year, Tom. Bullish on fixed income. It's not worked out that way with the sell-off continuing, but certainly getting an understanding of where he went wrong. And I think the explanation around it is really, really important. Traditionally, deficits don't matter. In downturns, they really don't, because people will buy treasuries. The point he's making, I think, is really interesting. It's difficult to get people to go out the curve for less yield when the data is still good and you're getting tons of bond supply, which is the point Steve is making.
I think the flow issue here is critical, but it also percolating into this weekend. And you really wonder, we were saying people can't vision out to 2024 right now. I really wonder the fiscal impact of this bond carnage that we've had. I've certainly underestimated it. And, you look at the rates of change in the Chicago-like mathematics of what's going on. And to Steve's point, is it about the debt and the deficit?
Bramo's been asking for a real-time ticker of that, haven't you, Lisa?
I want that. I want to have an understanding of how much the interest payments are going up in real time as you get the 10-year yield climbing. And I know that sounds nuts, but at the same time, that's the reality of it. And if it sticks, the fact that the U.S. did not push out their maturities the same way that corporations and individuals did means they are sensitive to those moves in a much more meaningful way than anybody else in the market.
We've got a former Fed governor around the table who was just like, yes, I want that too. I want that too. He's going to join us in just a second. Let's get to the price action on the S&P 500, positive by 0.1%, about 13 minutes away, 12 minutes away now from the payrolls report. Yields a little bit higher by a couple of basis points, 473.60. What an ugly week crude is have. Could close down close to 10% lower on the week, down to 82 on WTI. Worst week, TK, going back to March.
This is our interview of this bond carnage. There's no question about it. I've said for years that out of Brown University, the gentleman from Chicago is our definitive financial economist, and that's saying something at Booth School with Lars Hansen, Austin Goolsbee, and Raghu Rajan darkening the door. He's a former Fed governor. On this jobs day, we're going to rip up the script with Randall Krosner. I am so honored you are here with us today. I'm going to steal from Raghu the fault lines of Randall Krosner right now in this bond carnage linked into our greater economics. This is Booth School 101. Let's steal from Raghu and the fault lines of the great financial crisis. What are the fault lines you see right now in this bond carnage?
So I think that's exactly the important thing to be focusing on, is what are the unintended consequences of this? Because we know that interest rates are going up because people are concerned that the Fed's going to keep rates higher for longer. The markets finally seem to have gotten that message.
Right.
And I think Jay Powell's been pretty consistent on that for a very long time, but the markets are now focused on that. And we have to look at, well, what are the consequences of this? And we've seen around the world that when interest rates move up very rapidly, sometimes people who have been hedging properly or have been involved in a lot of leverage when they've been trying to hedge get into trouble. And so we're going to sort of see this over time. One of the manifestations, obviously, was Silicon Valley Bank earlier this year.
Yeah, and that's a small bank. Let's talk about the big banks. We've had a constant message that everything's fine with the big banks. I don't buy it for a minute because I heard the same tune in July of 2007. On a tranche basis, everybody's focused, including the media, on the garbage of the tranches. I'm going to go with David Goldman, and I'm worried about price movement in the better quality, middle quality tranches. Do you people at Booth have a conviction that they will sustain and get through this carnage?
So I only speak for myself. As you know, at University of Chicago, every person speaks for themselves. So I can't represent other people's views. But I think it's very interesting to look there, because if you go back to the global financial crisis, it was exactly that it was when markets started to get worried about the top
tier stuff.
So the bottom quality, that had fallen out much earlier, but it wasn't until really the summer of 2007 that the top parts got in trouble.
I love catching up with former Fed officials, Randy, because they're no longer burdened by the shackles of responsibility.
The shackles.
They can just tell us what they think. Can you tell me what you think they're probably discussing on the committee after the sell-off we've seen in the Treasury market? How do those conversations go?
So you'll have different views around the table. You're going to have some people who are going, finally, the markets understand what we're about, and they've got it, and that does our job for us to some extent, because the markets weren't believing them. The markets kept thinking, oh, well, these guys, they say that they're going to hang tough, but most people in the markets have only been there for 10, 20 years. And they don't realize that in the old days, the Fed really would hang tough. They've only seen what's happened really since the global financial crisis. But the traditional approach is that when the party really gets going, the Fed takes the punch bowl away. And they're willing to do that, and the markets are finally getting that. So I think that's the discussion. Are they getting it? And then the question is, are they getting it too much?
As a Fed governor, would you sit there in real time and dial up a colleague on the board of governors and have a conversation about what is developing? How does that work out?
So it's exactly that. So there would be things, issues that would come up, and we might have a small group meeting, or we might have just a one-on-one on what's going on. How do we understand this? Does this fit with our models, or is there something different here? Then we might have ask for a briefing from the staff about, gee, is there something new here? Should we be using alternative approaches? Most people ended up with the traditional approaches, but it was usually
Can you think of an occasion where things did really change for you, where you had to pick up the phone and say, this isn't right?
Oh, certainly in the starting in the probably August, September of 2008. That was really when things were not moving by the playbook, and we knew something was terribly wrong. It's like, we really got to work through this.
Do you feel like at this point you would change your view? If you were on the Fed, all things being equal, based on the pace of the move, do you agree with the Mary Daly view of things, that if yields do stay at this level, that will remove the need to raise rates again?
So there's the short run interest rate and the longer run interest rate. And obviously, we've been focusing more on the 10-year rate, which has moved up very dramatically because people have finally gotten the message that the Fed's going to keep interest rates high for a while. I think it really would depend on how the data evolve. I mean, we're going to get a very important number in just a few minutes. We're also going to get some more inflation numbers. And so you might want to move a little bit more if the economy continued to seem very strong, if the labor market continues to be strong, if we're getting a lot of wage pressure, because the 10-year rate does a lot, but it doesn't do everything.
This is a difficult time, isn't it? It's very uncertain, and all of the data points that people say matter so much are really pocked with a lot of uncertainty and revisions backwards that are perhaps not necessarily that accurate. So which data point is the most important? Which do you watch the most closely?
So I'd say, I'd go to two. One is the data points that we're going to be getting today, and the other are on inflation itself. And in particular, the core personal consumption expenditure index, not the CPI, because the CPI is too focused on housing. The PCE has a little bit less of the housing in it, a little bit more of sort of general services, and so that tends to tell you a little bit more about where inflation is going. So labor market and the inflation numbers.
I talked to the president last night, and I said if Michael Barr has to step aside, Krosner would be perfect as a vice chairman for regulation. And I don't want to keep you busy here. Michael Barr's got to be worrying today through October about mark-to-market. Now, maybe it's a little bit away from your remit, but the answer is we've got this confidence, which Michael Spence has written about. OMG, we fixed it in 08, 09. We fixed mark-to-market. We have great transparency with our major banks. I don't buy it for a minute. Do you have confidence that the Fed has knowledge of the opaqueness between mark-to-market and the free-for-all of this bond market?
So they know there's an opacity there. Do they know the exact numbers? No one knows that. Precisely because...
Can they measure the opacity?
You can get a feeling for how much you don't know, but it's like you can say, well, gee, we know that these are not being priced to market too quickly. You can't say, I know what that market price would be.
I got goosebumps. That was Grossman Stiglitz from a million years ago. What he said that's so important is you know what you don't know. That doesn't help you if your bond's moving from 82 down to 78.
We don't know the jobs report. We know that. It comes out in about 5 minutes. We'll find out what it is in just a moment. Mike McKee's standing by. He's going to break that down for you in just a moment. Off the other side of that, we're going to catch up with Jeff Rosenberg of BlackRock. In your equity market going into all of this, on the S&P 500, we're positive by 0.1%. In the bond market, we look a little something like this in the Treasury market. Yields, Tom, higher this morning by about 3 basis points on a 10-year, 474.85. Mike McKee, can you give us the tease for 5 minutes' time?
I think what we're going to see today is a bond market that's like a coiled spring for this. When you look at the whisper number, it's 189 right now, and the forecast is for 170. You noted that the 10-year yield is up about 3 basis points. Everything's kind of coiled to go higher if we get an upside surprise. And so that'll be the real story, not so much what the number is today, but how the bond market interprets it. We also expect the unemployment rate to go down a bit. So if that doesn't happen, there'll probably be some confusion for a few minutes till we figure out why, whether it was more people in the labor force or whether people are starting to get laid off. So it's going to be interesting to watch the reaction to this, even more so than the numbers themselves.
Mike, to steal from Randall Krosner of Booth School Chicago, you know what you don't know. What's your biggest mystery in this jobs report?
I don't know what I don't know, Tom. Actually, I think the one thing we don't know that could matter is the number of people who come into the labor force. It was over 700,000 last month, and that's what pushed the unemployment rate up. That's considered a good kind of move. But if we get a much smaller number, that could help the unemployment rate go back down again. We don't know what that number is going to be. Probably we have an interestingly wide range for the jobs report itself. Steve Stanley up there at 250,000. So that'll be something we don't know either. That'll be interesting to find out.
Randy, your final thought before we get this figure in terms of what you're looking for in the granular data, what you're trying to understand.
So really the key will come down to wage growth, because that's one of the key things. It's, you know, if you think about what the costs of production are, even for manufacturing, wages are and labor costs are a very significant fraction of that. And of course, in services, it's almost everything. And so if you think about where are the cost drivers going to be going forward, it's in the labor market and in particular the wages that we'll be getting just in a few minutes.
What did you think of the forecast from the Fed a couple of weeks ago? Aspirational?
So as you know, people talk about hard, soft landing. Jay Powell's talking about softish landing. I've been talking about hardish landing.
Hardish, what's that?
That means that I really think that we can't get out of this without a substantial slowdown, possibly recession, not off the cliff. But I really don't think we're going to get out of this without a substantial slowdown. And I didn't really see that as much in the data or in their forecasts as I would have been forecasting.
Randy, stick with us. We're going to break this down in a moment. TK, the estimate, as you know, well by now, 170,000.
Halloween 2009, a 10% unemployment rate. This jobs report is important is the angst we felt at 10%. Completely different. It's about finance and bonds, not about the real economy. But I got to go back to Halloween of 2009.
Elisa, what are you looking for? Headline number, 170, that's the estimate. Unemployment, looking for that to come down to about 3.7 from 3.8. Wage growth, average hourly earnings, month on month, looking for 0.3 up from 0.2.
Honestly, I'm watching the bond market and its response, to quote McKee. I mean, honestly, to me, that's going to be the most interesting thing. If we get an upside surprise, does it get revised downward next month? We shall see.
Well, let's go through the price action for you, how we're set up ahead of all of this. I've gone through the numbers that we're looking for. 170,000 is the median estimate in our survey. Let's start with equities on the S&P 500, positive here by 0.1%, heading potentially towards a fifth week of losses on the S&P 500. I've said it a few times already this morning, but the fate of this market today, very much to some extent, to a greater extent, in the hands of the data you'll see in about 20 seconds' time. In the bond market, yields look like this on a 2-year, a 10-year, a 30-year. Earlier in the week, a 30-year through 5% this morning, 490.34. Yields up on a 10-year maturity, up by a couple of basis points. New cycle highs earlier this week. The yield right now on a 10-year maturity in America, 473.81. With the labour market data, let's get to Mike McKee. Hey, Mike.
Good morning, guys. And the numbers are just coming out now. Unemployment unchanged at 3.8%. That's the first number we get this morning. Payrolls, though, wow, 336,000. Let me repeat that. 336,000. Change in private payrolls, 263,000. Remember, ADP said 89. The change in manufacturing payrolls up 17,000. And for the months of July and August, we've got a revision of plus 119,000. So the labor market considerably stronger than people thought. Average hourly earnings, Randy was worried about that, just up 0.2%. That's much lower than anticipated, same as last month, which pushes the average hourly earnings on a year-over-year basis to 4.2%. Labor force participation still at 62.8, so not a major concern there. And in terms of the establishment data, leisure and hospitality still the leader, 96,000 jobs during the month. Government employment increased by 73,000. Now, there were questions about the seasonal adjustment for teachers in August, and so that may be a bit of a payback there. And I'll have to look up, well, here we go, transportation and warehousing up 9,000, truck transportation adding 9,000 jobs. Remember, we lost 37,000 in August when Yellow went out of business. Looks like about 9,000 of those reabsorbed. I'll go through this. You guys check out what the bond market is doing, because this is sort of the mother of all upside surprises.
I don't need to check, Mike. You can already guess. Mike, thank you. The sell-off resumes. Slow down. What slowed down? Major upside surprise on the headline number. This is a knee-jerk reaction. It always is. Let's see if it sticks. But I'll give you the price action right now. Equities down hard by about 0.7% on the S&P 500. Let's slice and dice the bond market for you. 2-year, 10-year, 30-year, 2-year up by 6 or 7 basis points to just short of 5.1%. 10-year high by 7 basis points to 4.79. 30-year had a look at 5% earlier this week. We're heading back towards it, up about 6 basis points right now to 4.95. Once you've guessed where the bond market's going, you can assume where foreign exchange is. The euro breaking down against the dollar, just about holding on to 105. 105.20 on the euro against the dollar. TK we're negative by 1/3%. I'm going to say it, Tom. It's early days. I know it can change, but good news was just bad news maybe for this market, Tom. At least for now.
I'm not going to insult Randy Krosner with the good news, bad news silliness. What I'm going to look at is a 2 standard deviation move up in the inflation-adjusted rate. And John, I just can't say this enough. I go to a real rate analysis. We'll do that with our great team of people, commercial-free for you in the next 28 minutes. Michael McKee takes a second look at the impossibility of 18 pages of data. Mike, what do you see?
Well, I'm looking through where we found jobs. Construction's still adding 11,000 during the month, so the builders are still putting homes in the ground, and they're still looking to find people. The manufacturing jobs I mentioned earlier, 17,000. There have been questions about what would happen, but the ISM number earlier this week suggested we would see an increase, and we do. Retail adds 19,700. I don't need to do the point there. And professional and business services adds 21,000. That was a big category of gain in some of the earlier numbers this week. So it's interesting that we see that follow through. It's an area where if you're adding jobs, it's a suggestion that maybe companies are still looking for more. So it looks at this point like the overall number is solid, and it comes from a lot of different categories, not just hiring in one or the other.
If you were hoping to get away for the weekend, stick around. I guess you've got no choice now. Stick around for the next hour on Bloomberg TV as well. Coming up at the Open, Bloomberg's opinion columnist Mohammed Al-Erin and president of Queen's College, Cambridge, Mike Collins of PGIM Fixed Income, Victoria Fernandez of Crossmark, plus reaction from the administration in Washington at 9:45 Eastern Time. We'll hear from the acting U.S. Labor Secretary, Julie Su. TK, this market down by about 1% on the S&P.
Let me do a data check here as we get to Governor Krosner here in a moment, and that is I'm going to give you a 5% 30-year bond in moments, 4.99% right now, 10-year. We've got a new initiative here to a higher yield, lower price as people consider Michael McKee saying that this job report was across many, many different sectors. It was not a dysfunction or singular or that. Randy Krosner with the Booth School, Chicago. Randy, I'm going to go from a nominal to a real rate analysis. Let's go back to first principles. I never framed a 2.50 10-year real yield. Why does the real yield matter, and how will that new high real yield change our listeners' and viewers' lives?
Because ultimately it is the inflation-adjusted rate. It's the real rate, you said, that matters for thinking about what investments firms are going to be willing to make. Because if prices are going up and they can input prices are going up, that's one thing. But if you adjust for the inflation, so you take out that changes in cost and changes in prices on both sides, you've got the real yield. And if that's going up very significantly, that means that firms are going to be less willing to invest. Are they less willing to hire? We've also started to see real wages grow, which is great for workers, but that's probably at some point going to mean a little bit less demand. Obviously not right now.
Well, that's where I wanted to go. What's your reaction as a former Fed governor to this report that is not only a massive upside surprise, almost twice as much as what the expectation was, but also with an upside revision to the prior month? What would you, if you were still on the Fed, do with this?
So I think look at two pieces. One, obviously the incredible strength of the labor market continuing to be there. But the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that in a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks. I find it hard to believe. It's possible. After being at the Fed during the global financial crisis, I never say never about anything. But we've never seen something so perfectly Goldilocks before. But if you can have a strong labor market but not have real wage growth being too high, that would be ideal for the Fed.
One thing that I'm seeing is the underemployment rate coming in a little bit, 7% from 7.1%. It goes to the Priya-Misra question, which would lead to a higher neutral rate longer term if we get an increase in productivity, if we see some sort of just general growth that means a higher inflation, higher growth kind of era. Are you hearing anything, seeing anything in this data that suggests that has a greater likelihood than you previously thought imaginable?
Well, not the data today, but we have been seeing some pretty good numbers related to productivity growth. And ultimately, that's what we want to see. Higher productivity growth is great for economic growth and great for real wage increases for workers. Now, whether that's just sort of a one-off thing, it's going to take a lot more data to figure that out.
Tell me at the Booth School, is you people own the high ground on the analysis of our finance and to say one emotional thing, commercial real estate. The fact is, in the carnage that we're in right now, 30-year bond, 4.98%, we're going to have a normal American failure of restructuring, failure of businesses, new fresh money will come in and, at a lower distressed price than that. Will we just survive this event, or can there be lasting damage here like there was in 07, 08, 09?
So I think we really need to rethink the business model of how this is financed, because a lot of small and medium-sized banks have a lot of exposure in this area. The chickens are going to come home to roost because interest rates are a lot higher, so refinancing rates will be higher. There are a lot fewer people going into the office, so a lot of the commercial real estate values are going down. And I think a lot of the small and medium-sized banks are going to be stepping away from this. So I think the question is going to be, who will be financing this going forward? The big banks don't seem to have any appetite to do that. Maybe it'll be new players like private credit coming in, but that's very new. We will have to see.
But the heart of the matter here, Professor Krosner, is for the fossils like me, the collective memory of our youth of continental Illinois, out of nowhere. What are the shadows right now that you see of a continental Illinois, of portfolio insurance in 87, the leverage of 98? What's the Krosner shadow right now you're most focused on?
So I do think trying to understand what's going on with commercial real estate, how that's going to affect small and medium-sized banks is very important. And then also trying to look through into the areas we don't know about. This gets back to what we were talking about before, into the non-bank financial sector. So we've got a lot of data about banks.
Right.
But just as I was describing, there are a lot of non-banks who are doing traditional bank functions. We don't have as much insight into that. So that's something that we know we don't know, and we have to find out a lot more information about that.
That's another 1 hour conversation with Professor Krosner. We'll do that at another time. We are honored you're with us today. For all of us at Bloomberg, thank you so much. Randall Krosner of the Booth School, Chicago. We're also honored that Jeffrey Rosenberg could dart in the door. He was just looking at his Bloomberg terminal. Jeff Rosenberg, let's take this all-in non-farm payrolls. I have the number here, 455,000 with revision. Take that shock into your shock of working at BlackRock this week in fixed income. How do you dovetail the two?
Well, I think I'm gonna talk about something that we usually don't talk about on a Payroll Friday, and that's third quarter earnings, which begin to kick off. And what this payroll report really, I think, starts to reconcile is a disconnect that we've been hearing between kind of the bond market consensus, soft landing, inflation, slowing labor markets, and at the same time, a very positive corporate profits, margins holding up. And here's the problem with those two stories is that how do you get the slowing in labor? How do you get layoffs if corporations are doing just fine with pass-through and with margins? And so the reconciliation of those two inconsistencies is on display right now. This is a much stronger labor market, clearly. That's what we see in the report today across the board. And so the challenge is, and what you were relating to with Randy Krosner, is that this is an environment where rates are going to have to stay higher for longer, potentially even go higher. And the longer that occurs, the more those cracks and that vulnerability has time to eventually show up. But this is really telling you something that the equity markets have been telling you, that it's good for corporations, good profit margins, good earnings, isn't a good story for labor market normalization and for the inflation story.
Jeff Rosenberg, Mr. Fink's office called me this morning as I was coming in, and they said, don't ask Jeff Rosenberg anything about inside baseball at BlackRock. I will not. But I will ask you about the functioning of our fixed income market off this shock report. Are there instabilities visible outside of BlackRock that you see? Can we get transactions done as we get ever higher yields?
You know, it's been a remarkably orderly move higher in terms of market functioning.
Agreed.
In terms of liquidity. I think the issue that you, again, just went through with Randy about where are the cracks, where are the vulnerabilities, and Randy highlighted, you know, the change in intermediation. The financial system is much more disintermediated today and in different ways that we haven't seen before. And so the story and the history is that as you have these shocks in terms of interest rates, there are vulnerabilities. The challenge is this time will be different in terms of where those vulnerabilities show up, and that will be surprising. I think the key here is that coming off of over a decade of zero interest rates, we established a lot of expectation for the persistence of low interest rates. And yes, there's a lot of liquidity still left over, private credit, dry powder. The issue isn't the liquidity, it's now the cost of that liquidity and whether or not you can afford those much higher interest rates. I think the thing to be aware of, however, is that in the private credit market environment, you don't have the same kind of liquidity triggers that you have in the banking sector. You mentioned continental Illinois. You don't have deposit runs. So you have a lot more flexibility to extend the time period, a lot more flexibility to limit any kind of spillover shock risk. So it functions in a different way, but it doesn't mean that there isn't still eventually the cost to be paid for a much higher interest rate environment.
Right now, as you talk, we are seeing the markets break down in a pretty significant way. We're seeing that 30-year yield climb back up toward that 5% mark, 4.98%. You could see 10-year yields climbing back up near the highs that we saw earlier in the week. 10 basis point move. Yeah, really just a moonshot, 4.82%. It's coming in, it's going up. It's definitely a volatile morning. The euro going down to 1.051. So you could see it just flirting with that 105 level. Jeff Rosenberg of BlackRock, I am curious from your vantage point why you would buy bonds here if you see this kind of strength in the labor market persisting.
Well, I think when you say why would you buy bonds, I think one of the key things about the fixed income markets is there's a very different level of opportunity set across the yield curve. And so the front end of the yield curve is really pricing in a lot of the forward path. The movement today basically pricing in now 100% of the final increase in interest rates. You know, if inflation and the kind of one silver lining in today's report is average hourly earnings, you know, if that picture still maintains, then the Fed can hold rates at high levels, but doesn't necessarily have to go further. That's already in the price. And when you look at the back end of the curve, yes, there's more vulnerability. Yes, we still think there's more term premium steepening to go, but you're starting now just finally to get to levels where you're getting back to normal. And that movement from abnormal to normal is very painful, but where you're getting closer, and that's interest rates that approximate nominal GDP. That's the history of where the long-term interest rate should be, and you're getting closer to that. You may overshoot, and you may have more term premium risk because of the deficits and QT, so we're a little bit cautious on the back end, but why would you buy bonds? You may not want to buy bonds like 30-year bonds, but the front end of the curve is really starting to get to levels that are much more attractive.
For 2007 and on, this is one of the historic days we've had on Bloomberg Surveillance. We welcome all of you commercial-free here through the hour. Michael McKee with us, Jeffrey Rosenberg of BlackRock, Ira Jersey scheduled to be with us as well. On the data check front, equity markets somewhat quiescent. We're out a stick on the VIX, 19.46, and basically a 1% move in the Dow, the NASDAQ, SPX does fractionally better. SPX is down 0.8% as well. I can't say enough about the moves in the bond market. If I keep talking, Lisa, we're going to get a 5% print on a 30-year bond. I can round it up right now. We need to get a reassessment of this historic jobs report, 455,000 with revisions. Michael McKee with one more insight.
Well, it's a fascinating number, Tom, because nobody expected it that high. Steve Stanley was by far the highest on Wall Street at 250,000. So it does show that people are still looking for workers. Now, the question is, when you have a number like this, how much of a drop-off are you going to get the next month? Or are we going to keep this sort of thing going? Some of this may be payback for numbers that were a little odd last time, like the yellow trucking went out of business and subtracted 37,000 jobs, 9,000 came back, so we don't get that effect again. And there obviously was a seasonal adjustment issue with education because we got 40,000 additional folks in education during the month. But it's still a very, very strong number. Now, the interesting thing I take away from this is that with the 10-year note yield headed to wherever Tom drives it, does this mean that the strong number pushes Wall Street to reprice for yet another Fed move, or is this the Fed move? When you go back to Mary Daly yesterday saying that the market yields rising had the equivalent effect of another 25 basis point increase. Does this mean the Fed has to move or not? And I think a lot of that probably comes down to next week, the CPI numbers that we get. If the inflation rate is still going down and we didn't see a big wage increase here, then it's okay to have this kind of job growth.
Right now, definitely the bond market is speaking, and they are doing a lot of work in terms of tightening financial conditions. I'm also watching the euro breaking down below 105 now, 104.99. Jeff Rosenberg of BlackRock still with us. And from your vantage point, is this the one hedge that has worked in this period of turmoil? Buy the dollar.
Yeah, it's been pretty much rate driven, and I think as you're highlighting this morning, that rate move is reflective of the move in the dollar is reflective of that rate move. I want to go back to what Mike McKee was just saying in terms of the Fed, and I think that is what you're seeing in terms of pricing in the last hike. And I think also as well, they will recognize that the market is doing a lot of the work for them, and we're going to get the tightening in financial conditions, and they were hoping to avoid an easing of financial conditions, which is what they've gotten here. So I think that helps to kind of move us off of the Fed tightening path. The real issue in terms of the bond market pricing into next year is we've priced out about half after the FOMC, half of the cuts that were priced into next year. And I think that's the next move that you can start to see, is really pricing out the cuts as you get more of this higher restrictive for longer kind of perspective.
And we did see that 30-year Treasury yield across that 5% mark just briefly, but flirting once again with that level. Jeff, how much is this a sustainable rate? You said pricing out cuts going beyond 2024. Is this sustainable economically and from a risk asset perspective?
Well, a lot of that depends on this projection in terms of the inflation trajectory, right? So the reason for the cuts priced in, or one of the reasons for the cuts priced in by the bond market, is the expectation that inflation starts to fall, and the Fed wants to cut rates so that, you were talking about it earlier, Tom, not having real rates go up as inflation goes down. So is it sustainable? Yes, but a lot of that's going to go, and Mike McKee, you hit it on the head, next week in the CPI report. It's a very strong jobs report. A big component of the inflation expectations declining is that core services ex housing, which is really related to the jobs market. So good news here so far is AHE, average hourly earnings, not ticking up. as long as you see that inflation trajectory go down, then I think you can get that pricing in the second half of next year.
Jeff
But it's
Rosenberg,
very much dependent on that inflation.
Jeff, I want to go to you with one more important question. Stay with us, and we're going to bring in Ira Jersey right now, Bloomberg Intelligence. Moments ago, folks, we have a 30-year bond of 5.01%. Lisa will tell you what the bank rate 30-year mortgage is going to set at on Monday. Who knows? So we have Ira Jersey and Jeffrey Rosenberg to get us to the next hour. Dr. Alarian will join Mr. Ferro here in the hour. I'm thrilled to tell you Paul Sankey will join us on Exxon Pioneer on Bloomberg Radio here in a bit. Jeff Rosenberg, I want to cut to the chase. I've got a multi-standard deviation move in price in a blended bond index like the Bloomberg Total Return Index from the peak of the market in January in 2021. How do you frame out, Jeff Rosenberg, that institutions, retail, and retired America will somehow get back to the pricing of the Great Moderation? You must be looking at in years.
Yeah, and I'm not sure, Tom, the framing is that we're getting back to the pricing of the Great Moderation. And I think that's part of the adjustment here, is that you may not have that bond market that you were used to in terms of an upwardly sloped yield curve, falling interest rates, a high positive total return, and most importantly, a reliable ballast to your stocks. It's a very different bond market, and this is the transition period, and I think investors have to really recognize that. And so the opportunities are really changing how you hold your bonds in your portfolio. It's much more in the front end. It's much more about flight to quality. Insurance is no longer the 30-year. It's the front end of the curve. It's a steepening when you have a crisis because you've got that rate possibility priced back into the curve. So a lot of changes in thinking about how we build portfolios.
Jeff Rosenberg, thank you so much for taking the time on a day that truly is historic, as Tom was saying. Just looking at the 30-year yield right now, we are seeing on an intraday level the highest rates going back to August of 2007, solidly through 5%, 5.02%. Ira Jersey, Chief U.S. Interest Rate Strategist of Bloomberg Intelligence, joining us. And I've got to say, what a moment. Is this being driven by sellers or by a complete lack of buyers who have no conviction at a time when the U.S. economy seems to be running hot?
Well, today has to be sellers, just because you wouldn't expect a lack of buying to generate a 10 basis point move in the long end of the yield curve. I agree with a lot of what Jeffrey said. I think the thing that we have to think about here is who's going to be the incremental buyer going forward. And when you have the global rate environment changing so significantly with positive yields in jurisdictions like Germany and Japan that had more than a decade of negative interest rates, now there's alternatives to just people buying treasuries. So I do think that we have shifted the demand dynamics and we need more domestic involvement. And we've seen that over the last year, but that's also come with yields rising pretty significantly.
I got to say, Ira, I'm looking at something close to a 20 basis point move in a 10-year yield as it pushes up toward 4.9%. Is this healthy? Is this okay?
Well, liquidity in the bond market has gone down very significantly as you have new regulatory environment that's changed the way that the bond market trades on a day-to-day basis. So I think when you get moves that seem pretty large like this, one, are they fundamentally driven? The answer to today's move, I think, is yes. But then they just get pushed out even further than you would expect on if liquidity was decent. You don't have the leverage in the system you used to have, so you don't have levered investors who might say, hey, I'll take a punt, and if we sell off 20 basis points, I'll try to clip 5 basis points going the other way when the market gets oversold. You don't have those people anymore.
Ira Jersey, you have so much perspective on this. Just thrilled to have you. And folks, I can't tell you enough about our team putting together Krosner, then Rosenberg, and now Ira Jersey. The market's walking away, Ira Jersey. There's no other way to put it. While you're talking, we're out to a 503, even 504 10-year. I've got a 30-year rather. I've got a 10-year yield back to the summer pre-August, third week of August of 2007. And if I look away and have some tang, I got the 10-year real yield out to 2.56%. Ira Jersey, you and I know, as Chris Whalen talks about, there's a point where there isn't somebody on the other side of the phone. Price down, you need to get rid of it, and you can't sell it. Are we anywhere near that analog?
Well, I think we're close depending on who you're talking about. And, I think your real yield point, Tom, is really interesting because with TIPS yields heading back, it seems, toward maybe 3%, at some point there's going to be value seekers in the markets. And we're just not quite at that kind of level yet, particularly with the repricing of how long the Federal Reserve is going to maintain rates at the peak. November almost doesn't matter. Even if the Fed hikes in November or doesn't hike in November, it's really, do they not then cut until 2025 or maybe even 2026?
Right.
So that's been one of the keys, I think, for the market here in the adjustment is, does it make sense to buy a 10-year yield when you can buy a 2-year note or a one-year T-bill well above 5%, and you think that you're going to be able to get that for the next 18 months. So it doesn't make sense to buy the long end if you get a better risk-adjusted return in the front end.
To the idea of the never of this October, Lisa, he just said it. I've never framed a 3% real yield. That was something from another, I don't think I had gray hair. It's from another time and place. What Mr. Jersey just said there, a 3% real yield. You tell me how Business America operates.
They are going to have to grapple with that. We're looking at right now close to 2.6% in terms of a real yield on a 10-year. So it's really moving in real time. Ira, I want to go back to something that Priya Misra said earlier in the show, talking about how banks are one of the biggest buyers that have stepped back, that basically are no longer hoovering up U.S. government debt. How much is this one of the main features, aside from China, aside from Japan, that really is one of the big drivers at a time when they used to reliably be a base for the U.S. government?
Well, so really, banks are not massive holders of all of the outstanding Treasury securities in the country, but they are one of the incremental buyers, right? So banks will step in, and they have a choice of whether or not to make a loan or buy mortgage-backed securities or buy Treasuries. And owning some Treasuries is something that they have to do now because of the regulatory changes that went in about a decade ago. So banks are always going to be regular buyers. I think that at this point, banks have alternatives to what how they can manage their portfolios and manage their regulatory risk. So they can own a lot of reserves, right? So the Federal Reserve has kind of created this dynamic where banks don't need to buy as many Treasuries yet because of the what's going on with their reserve balances.
Ira, a busy day of publishing for you and Bloomberg Intelligence. Thank you so much. Ian Ling and BMO Capital Markets looking for 5% 10-year yields on the horizon and does speak to the instabilities it will bring to the real economy. Our instability is to ask one final question of Michael McKee, who actually knows what he's talking about.
Oh, I wish I did, because somebody asked me, why did economists get this wrong? I said, I don't have a good answer right now. I'll have to look into that. We've just underestimated all along the strength of the U.S. economy. And when I say we, I'm including the Fed in that. And so it does change the game a little bit if we continue to see this kind of strength. 266,000 average each month for the past 3 months. That is not an economy that is going into recession. Takes that off the table. But the good news is average hourly earnings did not rise very much. So if CPI comes in soft, then how do you position the bonds?
Our final guest for the morning is Lisa Abramowicz, because this is her wheelhouse. The heart of the matter of Lincoln's note, of Rosenberg, of Jersey, of Krosner is your world. How do we move from a full faith and credit analysis out into credit, into stress? What do you think will be the ramifications?
What we already have seen is the worst period of time, the worst sell-off in credit going back to March when everybody was worried about a banking system collapse. At this point, this is where we start to see people worry about refinancing risk 1 year out, 2 years out for some of these high-yield companies. When does this become a sort of self-killing cycle where these yields have to come down because something breaks? I don't know the answer, and I don't think anybody does.
An historic moment for the financial markets. Please stay with Bloomberg Television and Bloomberg Radio through this morning. El Arian with John Ferro next.